market's convinced the Federal Reserve is going to become more aggressive.
If they're going to do 75, it's better to do it sooner than later.
The Fed doesn't have much reason at this point to slow the pace of rate hikes.
For the next 6 to 12 months, things are going to be much more challenging.
We still think the base case is no recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene. Thrilled you're with us on radio and television. Kaylee Lyons in for Jonathan Ferro in Capri. Thank you for your response to what we did yesterday. It continues today. And I love, Lisa, all the little tea leaves. We'll get to those in a moment. Hartnett over at Bank of America saying, look forward to the summer of Volcker.
And are we there yet with respect to the cathartic puke, or is this the beginning of the summer of Volcker?
Puke, they were such
and
a
how
good
much?
band. I loved what they did.
Well, but this is really what people were talking about yesterday, and the lack of understanding in some of the notes on Wall Street as to what was happening. Was this just a lack of buyers? Was there forced selling? When do the margin calls start? When do we see something break?
You know, that night, Kaylee, where cathartic puke played at UVA, the night they beat Duke and they were thrown off Kansas. Where did this language come from, Kaylee? It is so unladylike to call it a cathartic puke.
But
it's
it is
not.
A great band name.
It's called a bear market.
I'm all for that. Well, it is a bear market, and that begs the question, Tom, of now that we've fallen into a bear market, is the dip buyable, or have we not yet seen that kind of capitulation that you actually need? And while you saw futures higher, they're well off session highs. We're only up about 0.4 on the S&P 500, so it isn't that much of a convincing rally this morning.
Lisa pulled an all-nighter on her morning brief. We're going to get to that in a moment. But, Lisa, I want to frame out the tea leaves I see right now. BitDog can't get a bid. It really had an ugly last 12 hours. Just moments ago, pound sterling broke down again to new weakness, a 121.10 there. A 119 sterling would be unimaginable. And I'd also point out, Lisa, maybe what matters, and it's your bailiwick, and that's a 2-year yield.
Yeah, 2-year yield coming off the highs that we saw yesterday since 2007. Real yields, I'm watching those because real yields on the 10-year rose to the highest levels going back to 2019, almost 0.7% at one point yesterday after being negative just a couple of months ago. Taking a look more broadly, you're seeing a little bit of a reversal. But again, is this conviction buying? Where are the convicted buyers at a time?
There's no conviction buying today.
Right, but I think that's important to know at a time after one of the worst sell-offs that we have seen in a long time, a solid bear market.
I'm going to do a data check in a moment. Kaylee, what are you observing this morning different from yesterday?
Well, at least there are some gainers I'm looking at underneath the surface of the equity market, because we have to talk about the breadth of yesterday's sell-off as well. No one was spared, not even energy, which has been the ballast, the only outperformer within the S&P 500. Energy stocks were down among the hardest declines yesterday. Only 5 stocks in the S&P 500 managed to end the day in positive territory. The breadth of the selling yesterday is more turning into breadth of buying this morning.
We look at equities, bonds, currencies, commodities. We start with the VIX 33.61, nicely elevated over that 30 level. A number of guests yesterday saying we need a cathartic move to 40 to really get it done. It hasn't happened. Futures bounce up 11, Dow futures up 61 as well. In the yield space, Lisa mentioned 2-year comes back, 30-year bond 3.31%. 2-10 spread is all over the place. Curdy's got a great chart on that we'll look at later. It looks beautiful on radio. Oil, I think, is underplayed. 123 off of Libya and tensions there on production. 123.12 on oil. $1 below recent highs as well. Gold can't get out of its way. Dollar stronger. DXY over 105 is very important right now. I'd note Euro 104.34. Swissy doesn't really get out of the way with Euro. That's about it right now. I don't think I can say much more. We need a brief. We need to calm down and have a brief.
I want to just say, we are watching regime change. I was looking at negative yielding bonds and the total volume outstanding. It has fallen to the lowest since 2015. We have revoked the era of low interest rates in the face of higher inflation. The latest on that higher inflation, 8:30 a.m. U.S. PPI for the month of May. Neil Dutta over at Renaissance, as Matt Miller has been talking about, calls this more important potentially than CPI. The reason why is because because it could indicate how much more pricing power or lack thereof companies have. How much more margin pressure do we see? You subtract PPI and then CPI and you see what you get. Right now, we're looking at an actual reacceleration because of food, because of energy prices, and that matters, even though a lot of people try to strip it out for some more consistent measure. At 11 a.m., President Biden is trying to shift the message again, talking about labor, speaking at the 29th AFL-CIO Quadrennial Constitutional Convention in Philadelphia, Pennsylvania. Can he shift it away from this story, which is gas and all gas, moving to a new all-time high, well above $5 a gallon on average across the nation? How does he get out from under this? And how does the Fed get out from under this, considering what it is doing to sentiment and what it is doing to longer-term expectations, the kickoff to that two-day meeting in Washington, D.C.? We're not going to play the Fed parlor game all day, although you might hear it in other places. I'm doing this for you, Tom. People talking about possibly a surprise 75 basis point rate hike at this meeting. My big question of the day, frankly, Tom, is will that be positive for markets or negative for markets if they surprise with a more hawkish move? And right now, that 2-10s yield curve, the flattest that we've seen. Yes, there have been periods briefly, but this to me tells a story of possibly stagflation or recession. And does the Fed care about this? Do they want to manage this? Or is it all about sending a really strong message to markets?
In a flighty yield curve as well. I'd say it's just bouncing around a lot. Let's get to conversation here, and that's where we'll address what the Fed's going to do. Look for our special tomorrow. I've got a great set of guests lined up. We start strong. Matt Luzetti will join us from Deutsche Bank for our Fed special tomorrow. And, of course, Deutsche Bank out with a recession call out in the distance, which right now looks on the edge of pression as well. Always pression. At Federated Hermes, Linda Dussel joins us there, senior equity strategist. Is your team under the desk? I mean, Linda, you know, are people hiding under the desk this morning?
I have to give my team credit because when we started this year, we said that we thought you'd see a lot of volatility and that cash might actually be king. It was the first time in my career at Federated Hermes that neither the bond representative nor the stock representative was very excited about their areas. So I think we're going through what we thought we would do. In our conversations at the office, we're saying that this is going a lot quicker, though, than what we thought.
Linda, is this it? Is this the cathartic puke? Tom accused me of not being very ladylike, but you don't want to buy when people are scared. And yet here we are, and that typically is the best time to buy. Is this it?
No, I don't think it's it. I mean, we see what's happening in the crypto. Crypto's having their puke, that's guaranteed. But I'm still seeing and hearing too many buy the dip ideas. We only came down 20% on the S&P, and I guess we tested it once here with a quick 10% bounce on really pretty poor volume. But I don't see why we shouldn't do even more damage than that. With all the money that was pushed into this system, so many people buying up, so many assets out there, and that does have to be wound back. And I think it might end up being probably a recession and probably maybe a couple of hundred more points downside on the S&P.
Linda, Lisa raised this briefly, the idea that now the market is kind of giving the Fed permission in some sense to move 75 basis points, or at least it wouldn't be all too surprising. Would the greater downside risk to equities be a Fed that acts too aggressively, is too hawkish, or is too dovish and there's little faith that they're able to rein in inflation?
Yeah, I think, how it works out, we're not so concerned. I think a 1% move would be a big shock, just a big shock to the markets. The 75 basis points versus 50 basis points. Like, I think we're kind of in this situation that says, whatever, they're going to keep on going. We find it interesting. Very recently, the betting out there for the Fed terminal rate is now up to almost 4%. So where we end this is very important. And we were talking about the PPI and how PPI and CPI particularly come down because we saw the M2 money growth peak in February of 2021, and historically about 13 months later, the CPI, the core starts to pull back down, which you might say it did a little bit in the last 2 months. So it might come down fairly quickly. I'm not betting on that right now, but that's what we really, really have to watch. And the Fed will just keep going on and being data dependent. And then QT is just a big mystery to all of us.
Well, Linda, you mentioned PPI, which raises the question of input costs and margins. Are margin estimates still too high for the rest of this year?
Yeah, that's what we're particularly concerned about is, as the news coming out of Target was that like just the tip of the iceberg. as to what might come next, and might more and more industries have to report, even if they had a good second quarter, that their outlook is that margins will be squeezed, because to date it was all PE multiple contraction. And if we start to pull down our earnings estimates, that's going to be a double whammy here for the market. So it could be a tough couple of months here.
Linda, thank you so much. Greatly appreciate it. Good perspective to get us started this morning. Lisa, I want to go to Europe as well, where we've got German yields out. We always look at them. And then, as John Ferro does, we look at Italy and I look at the DAX as well, but the Italy piece, and it is breaking out to new wides this morning. And Lisa, an underplayed story, I thought Zero Hedge did a great job on this last night, is the ebbing away in IG and high yield credit spreads. What is that velocity right now, Lisa? How wide are they going? How fast?
So for a lot of the sell-off that we saw this year, credit held in pretty well. No longer. The sell-off has actually accelerated at a pace that we have not seen going back to March of 2020, if you take a look at both investment grade and for high yield. And the average yields that you're getting are things that we have not seen going back years, particularly in the investment grade space. You're looking at nearly 5% on average for the all-in yield, which is actually what high yield was yielding not that long ago. This is a complete repricing. That's why I say this is a regime shift, Tom. How do we readjust? And when do we start to see things break down a little bit more? Or is this going to be orderly?
In 20 seconds, Lisa, one of the issues is we're readjusting with a near 6% mortgage rate. Julia Coronado featured that yesterday. All of a sudden, boom, 6%.
And it is starting to slow the sales. People are saying that it might not slow the actual purchase price to the degree that people expect just because of a dearth of a supply. This is a real big question. What does it do if you do get a housing market?
I think it's one of the mysteries.
It's one of the many mysteries of the market. I will say one of the other mysteries is what happened yesterday.
It's different than yesterday, folks, but I really want to emphasize there are certain tea leaves moving. Sterling, 121.09, my attention. Bitcoin can't get a bid, 22,300 as well. Please stay with us with more data checks today on Bloomberg Radio and Bloomberg Television. Good morning.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman, according to an NBC report. No immediate comment from the White House. Biden once promised to punish Saudi Arabia over its human rights abuses. The possible trip indicates his drive to lower gasoline prices and isolate Russia over its Ukraine war. Two Wall Street banks are withdrawing from handling trades of Russian debt. The Biden administration said last week it's banning U.S. investors from scooping up such assets. J.P. Morgan Chase and Goldman Sachs were still matching sellers who wanted out of the debts with buyers. The U.S. Treasury's Office of Foreign Assets Control says U.S. investigators aren't allowed to acquire them. The spending power of UK households fell the most in more than 20 years as wage increases were eaten up by the fastest inflation in decades, according to the Office for National Statistics. The figures show how pay for most workers is failing to benefit from the tightest labor market in living memory. And Hayes Fan, a member of Bloomberg News' bureau in Beijing, was released on bail in January, according to the Chinese embassy in D.C. It's been more than 1 year since she was detained on suspicion of national security law violations. Fan's case is said to be under investigation. Bloomberg editor-in-chief John Micklethwaite said, quote, "We will continue to do everything possible to help her and her family." Hong Kong residents will have to show a negative COVID-19 test result to enter the city's bars and nightclubs starting on Thursday and running through the end of the month. The decision comes as the city is seeing an increasing number of infections, in many cases driven by transmission at entertainment facilities that recently reopened. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Fed says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But what's next?
Some big questions about the next move, the one after that, and ultimately the destination.
So maybe they can let the high prices naturally bring down demand.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
They've already said 50 in June, 50 in July. Given how bad the announcement was Friday, I think what Chairman Powell can do is bring that 50 forward. Even though there might be an initial sell-off on 100 basis points, I think there'd be a subsequent rally because the Fed is finally getting hold of the narrative.
The pundits out in force on the mathematics that we will look at tomorrow afternoon with the Federal Reserve. Lisa and I and John and Kaylee Lyons, we're going to ignore a lot of that punditry and guesstimates because all that really matters is what the chairman, the vice chairman, the governors and the presidents decide around that table at the Eccles building. There are other tables in Washington, lots going on with the president in Washington. Anne-Marie Horton joins us now, our Bloomberg Washington correspondent. Anne-Marie, Greg Valliere makes really clear things have to change, this malaise at the White House. Define the malaise that you see from that beautiful camera perch you have across the green lawn near Lafayette Park.
Well, I think we saw it in the beginning of the month, right? The administration wanted to make this concerted effort to talk more, at least from a policy and communication of their policy point, about the economy. They obviously are getting hit hard in the polls about the economy. Inflation is #1 top concern of American voters as they gear up to go to the polls in November. And that's what they're trying to do. But of course, the issue is there's so many levers only the president can really pull when it comes to trying to tackle inflation. He's going to be talking about the economy today with the AFL-CIO. So this is going to be obviously about labor. We know the White House said that they're going to talk about building the economy from the middle class out, something the president likes to talk about. But if they're not going to change any sort of policies, we're still waiting on things like the China tariffs, then it is a sense that it's a continuation of that malaise.
And part of the tackling of inflation may be a trip by President Biden to the Middle East, to Saudi Arabia, to meet with Mohammed bin Salman, the Crown Prince. And the trip by NBC, this is being reported by them, would be from July 15th to July 16th. What would he be hoping to achieve in that meeting, ideally, that could help bring inflation down?
So 2 things. This meeting would likely be alongside other Gulf members from the GCC. And right now, Saudi Arabia is the country that has the presidency. It would also likely mean that Biden would have a meeting or would shake hands with the de facto ruler right now of Saudi Arabia, which is the Crown Prince, Mohammed bin Salman. So it's tricky politically, right? Because we all know what the president had said on the campaign trail. He wanted to make Saudi Arabia a pariah state. And now he would be going into the kingdom and setting foot on that soil. It also comes at a point, though, that the administration has been recalibrating in a sense, and a lot of capitals around the world have. How are they going to deal with diplomatic issues? Many allies are potentially frenemies that now for some other people are becoming allies. I'm not talking about Saudi in general. I'm just talking about in general because of the war in Ukraine. So you do have a shift in the administration on wanting to engage more with the kingdom. And also part of this, of course, is the price of gasoline. We're now north of $5 a barrel, a gallon on average. But we should note that Saudi Arabia, while they do have spare capacity, it is not enough to save $5 gasoline in America.
So this ultimately, Anne-Marie, is just about the optics being seen trying to do something about high oil prices.
Right, but the trip is not just going to be about energy. I mean, we've heard that from the White House, from the press secretary, but also people I'm talking to. There's a lot of other deliverables that this trip would have. So this would be energy, of course, but also security in the region, things like defense in the region, economics, climate ambitions this administration has, which, of course, Saudi Arabia, we do know that the Crown Prince has been trying to diversify his economy. We saw that just last week with, obviously, them taking on this brand new golf tournament.
Right.
This is something that the kingdom is trying to do, and so there'll be a breadth of issues that will be discussed.
Anne-Marie, can we break OPEC Plus? Is there a belief within the international relations zeitgeist that Mr. Biden or America or the allies can break OPEC Plus?
Well, the thing with OPEC is that even before Russia invaded Ukraine, OPEC itself, countries within OPEC have had wars at each other, and still the cartel has still lived to this day. So there is a lot of talk always about the death of OPEC and the death of OPEC Plus. But what the Saudis were able to do at the last meeting, being the de facto leader of this cartel and this group, was really walk this very fine line with giving an olive branch to the administration that since August has been asking for more oil, at the same time keeping Russia on board to agree to this increase in production. How long are they able to do that?
Right.
That's really the question.
Anne-Marie, thank you so much. We've got to go and look at the markets. Anne-Marie Horton in Washington this morning. Lisa Abramowicz, just moments ago, sterling, a 121.00, one indication of slowing economies in continental Europe.
And that comes after that labor market report that showed that real wages in the United Kingdom, kind of like in the U.S., fell to their lowest going back 21 years at least. Basically, inflation is eating away any gains people are seeing in terms of wages. This just speaks to the moment we're in. Also, just moments ago, Tom, I want to point you to this. The NFIB survey of small business optimism came out at its lowest reading in history, in its 48-year history, in terms of what small business owners expect over the next 6 months. This just sort of underscores this feeling of doom, both with respect to markets, but also in the real economy.
Yeah, I saw the report last night, embargoed, and I thought Bill Dunkelberg's report was incredibly nuanced, Lisa, about just the battle small businesses having pressed by inflation, and yet still that impulse, they can't get people to work.
Well, and so at what point do they stop trying to hire them? And this, I think, is what a lot of people are
indications
talking
of that
about.
yet?
That. No, not at all, which is potentially problematic because people want to see that to release the pressure from some of the price increases. But without price increases, people have that much less to spend on an inflation-adjusted basis. I know we don't want to play the Fed parlor game, but how is the Fed going to get ahead of this if they don't make a big move at this meeting and recognize, yes, we're seeing pain, and the response is opposite to what we otherwise would have done, say, a year or two ago?
You're cathartically pressing my buttons because you know I believe no central bank ever, quote unquote, gets ahead of this. I mean, Kaylee Lines, when you're studying,
pushing his buttons. I like this. I'm going to try to do that as much as
Everything
possible.
is cathartic.
Yeah.
Yeah, Pharaoh's not here. You can do it.
Button pressing.
Kaylee, I mean, this is like you're learning monetary history, freshwater history at UVA. I mean, the bottom line is central banks don't get ahead. They're data dependent, right?
Yeah, and they're following these markets, and the markets keep pushing them farther and farther, Tom. We now see even odds of a 75 basis point hike tomorrow. That is what the market is pricing.
That's what the market's pricing. We will
Lisa
wait
and I can
see.
both play the cathartic button-pushing game, Tom.
You know what? Let's go.
Well, good. Piling on, Claudia Sahm will join you. We are thrilled to bring you Claudia Sahm on this moment for the markets. Futures fade. Good morning, everyone. Bloomberg surveillance on another day of market turmoil. We're going to do more data checks here right now. Lisa, I just note a 120 print on sterling as well. What do you see, Lisa, that sticks out right now?
And if you take a look at the tape and you look at the cross-currency pairs, a lot of that has to do with the
away.
dollar strengthening and ebbing away some of the weakness that we saw earlier in the morning. And this comes along. I mean, actually, if you look at DXY, it just broke out positive here. So we had seen it weaker versus peer currencies. Now it's stronger. We're looking across the board. We had seen stronger gains. They are fading the S&P up nearly just 0.1%. But also that 10-year and 2-year yield, we actually saw buying come into the bond sector.
We may get an inversion any moment,
is
right?
Fading. And I really am watching that because at that point, the rate fear is not over.
It's a different character than yesterday, folks, but I really want to make clear there are little tea leaves here, including Italian paper moving out and the Italian-German spread moving out to new widespread for Italy. Right now, and this is a treasured moment, if you go to Fred, the St. Louis Fed iconic database, there is the Sahm rule. It would be good to speak to Claudia Sahm about her rule, the Sahm rule, which is a wonderful zero BS formula saying, wait, let's look at jobs and guess the recession. We get away from the Fed parlor game with some real economics. Claudia Sahm joins us today from Sahm Consulting. Claudia, real simple here. The job market says there's no recession, right?
Right, that's correct. We have a really strong job market. Lots of demand for workers, lots of jobs.
Do you see any indication that the market turmoil that we see, the financial system can go over and amend the job market?
Right, but what we're seeing both in financial markets and what the Fed is doing in terms of raising rates, they both have the ability to depress demand. How much consumers are willing to spend in the United States, consumers are the engine of growth. If they start spending less, there's less need for workers, and it could lead to layoffs. And that indicator, the SOM rule, is all about watching the unemployment rate creep up, and that's an indicator we're in a recession. So that's what we're looking for. And honestly, it doesn't have to be a lot of weakening.
Claudia, where are we considering all the fears of recession right now? Where do you think we are?
Right. Well, I feel really strongly that we are not in a recession today. Again, the labor market is really strong. If you look at consumer spending, people are out there spending, right? I mean, that's part of why we have the inflation. People are still spending a lot. And so we're not in a recession now, but that should be no comfort necessarily that we won't end up in one. And frankly, what we're seeing in the last, several days is what could easily turn into a self-fulfilling prophecy of spiraling down expectations, both in financial markets and also potentially among consumers. We need to see things cool off some. Again, on the demand, that's the tool the Fed has. But if we cool off too fast and too much, that's where we end up in a recession.
Claudia,
and those can come quickly.
We've heard that from a number of people, that it's the media or people who are coming out and saying, oh, look at how terrible things are. And then people get scared and then the inflation expectations go up. However, if you drive down any highway and you see the gas prices climbing as quickly as they are, if you go to grocery stores and you see how much higher your bill is than it was before, if you take a look at that, real wages in the United States on a weekly basis are negative 3.9%, the weakest in a long, long time. How do you get a sense that this is going to be positive for consumers and it's just a messaging problem?
Yeah, no, I don't think this is a messaging problem. I do think in the consumer sentiment, we saw really low numbers, not like Friday, but we saw numbers really head south on consumer sentiment last year around this time. And that coincided with gas prices really starting to take off. Gas and also food, gas in particular, just looms really large in how consumers think about inflation. It's the price they see every day. They don't need the media to tell them what gas prices are. What is difficult is that it's really hard it's really hard for the Fed to get food and gas prices down. And that's what people are really concerned about, because we need those. Those are more necessities. That is a supply side problem. It's not the Fed's problem. I mean, it is their problem right now because they're about inflation. But that's one that we shouldn't be promising consumers a lot of relief by the Fed raising 75 basis points, 50. Like, that's just not where they have the lever.
Yeah, it may be a problem for the Federal Reserve, but that doesn't mean that the Federal Reserve is inherently the solution, Claudia. Obviously, it's not just about rate hikes. It's not just about QT. We're also going to be looking at that summary of economic projections. I was speaking to a guest from Macro Hive earlier, Dominique Dworfurco, who basically said the SEP is going to show that the Fed has given up on a soft landing. Do you agree?
So I don't think the Fed is going to give up. I think what the one lever the Fed controls, and what I'm looking for in the SEP, is how fast do they want to push this to get inflation down, right? If they were really pushing, and the past SEP didn't say it, like if they wanted 2% end of this year, early next year, then yeah, we got a recession because they got to turn the screws.
I'm so happy, Kayla, you brought this up. Claudia, there's more Fed pontification going on right now than anything I've seen. No one's read Bernanke. No one's read the wonderful Alan Meltzer. Nobody's read Richard Timberlake and the Georgia School as well. Claudia, stop. Can you explain to all the Fed pundits ventilating, including to Kaylee Lines, can you explain that central banks are always ex post and data dependent? Do I have that right?
Absolutely. They are data dependent. And this episode, the data that we are dealing with right now are fundamentally different than what the Paul Volcker Fed was dealing with.
You.
And I think, yes.
No, but Kaylee, I think this is really important. There's a lot of ventilation going on, and I get it. People are scared of VIX of 33. You know the numbers better than me, Kaylee. The bottom line is adults like Claudia Sahm are saying they've got to wait to see the data.
Yeah, fair enough. And I'm glad we have Claudia Sahm here to talk about it because, as you say, Tom, there is just so much murmuring going on as investors try to figure out what exactly they are supposed to do with their money. And, of course, investors are also looking ahead to that producer price inflation data later on this morning. Claudia, are you in the camp that that is actually more important than the CPI data was because more components of that feed into PCE, which is what the Fed is really looking at?
Yeah, so the Fed isn't going to hang its hat on some nuance that the couple series that the PPI informs PCE are the ones doing well. I mean, the CPI was uniformly a bad read on Friday. Now, what one could hope for in the producer price index is we're starting to see some easing on the prices that are going into businesses, the kind of prices they're passing on. Because at the end of the day, though it is not talked about a lot, we have some very serious supply disruptions from COVID and from the war in Ukraine. And we need to see, to avoid a recession, we got to get some help on those pieces. It's not looking real encouraging.
Claudia, when we talk about data dependency, we are looking at data we have not seen in 40 years. We are looking at data that is potentially catastrophic for the lowest income in the United States and, frankly, around the world. At what point do the Fed respond to this data that we're looking at right now rather than parsing out the nuances and just take a look at that and say, we act big, and that is what our job is?
Yeah, so Fed Chair Jay Powell was very clear recently. They are looking for clear and convincing signs that inflation is coming down, right? This is not about jobs right now. Maybe they do, say, hey, we're going to give up some jobs, unemployment will rise. But really, this comes all down to what does that CPI look like? Are we really making progress? They got burned last year. I did too, on thinking that COVID disruptions would ease and that would help bring prices down. That wasn't the case. The data are too hard to parse right now, the little moving pieces. So it's just all eyes on the big number.
Claudia Sahm, thank you so much. Dr. Sahm, of course, Sahm Consulting here. And the Sahm rule, I really urge you to study it if you're part of Global Wall Street, linking in job dynamics into the recession. Call Lisa the tea leaves right now. I've got sterling 121.07. I'd also note the Italy-German spread, maybe one of the litmus papers of Europe, has just widened out to new width here. The distance between Italy and Germany ever wider.
Yeah, ever wider, back to levels that we saw during the peak of the pandemic in 2020. But if you take a look at an absolute level, Italian 10-year yields, higher than 4% at this point. That's the highest going back to 2014. We're looking at new levels that we had not seen in years and had not imagined. Is this what the ECB wants? At what point do they come in with some other program, or do they allow this spread to gap out and allow some of the euro existential crisis that people are wondering about that could potentially raise some discomfort among the member states?
And Kayleigh, to be honest here, with futures up 12, it's not that large of a bounce off negative 700 Dow points yesterday.
No, it's not convincing at all. Obviously, futures were up much more earlier on in the futures session, but we have now given back a large majority of those gains, at least when it comes to S&P E-minis. Not a convincing bounce at all, which raises the question of whether or not we are done, whether or not the worst is over. If yesterday was really the cathartic puke, ladylike or not, that is something you could call it. Capitulation, whatever the term is that you want to use, Tom. People are looking for that chaos, that forced selling, that ripples across the market. Was that it yesterday? I don't think we have an answer to that question.
Yeah, I got a wonderful email. Michael, thank you so much for listening in Austin, Texas. Cathartic Puke's playing Cheers Shot Bar down in Austin Friday and Saturday this weekend. Just if
Tom has tickets.
If anybody's interested.
He's playing.
And again, as Anne-Marie said, as we continue to monitor these markets, Lisa, I'm sorry, the elephant in the room is oil just has not given back. Do you know there's a global slowdown? Oil's supposed to go down, not.
Yeah, and that's what people are looking for. But even if oil prices come down, is that really going to change the price of a gallon of gas? Because refineries have been in short supply, and that's been a huge issue. It doesn't seem like the input prices are going to come down all that quickly. We had a crisis upon crisis. We had Ukraine and the war that Russia waged. We had the shutdowns in China following the pandemic. How do we model this out? How does the Fed parse out nuance in a very unnuanced inflationary headline number?
Stay with us through an eventful morning, including business inflation, the PPI series as well. The dollar, DXY 105, Mark McCormick in the 7 hour. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden, in an Oval Office meeting last week with key members of his cabinet, indicated he's leaning towards removing some products from the Trump administration's China tariffs list, according to an Axios report. With inflation at a 40-year high, the Biden administration is looking to show action on bringing down those prices. Beijing has reported the highest number of daily COVID-19 cases in 3 weeks. 74 infections were reported on Monday. That is the most since May 22nd, when the capital hit a record for the current outbreak. The nation's top official for pandemic control, Vice Premier Sun Chunlan, is urging Beijing to control the outbreak as soon as possible. Hong Kong's lobby group for fund managers is urging incoming Chief Executive John Lee to scrap quarantine rules for travelers. The Hong Kong Investment Funds Association says the city needs to restore its status as an international financial center. The body represents firms with more than $52 trillion in assets under management. And the spending power of UK households fell the most in more than 20 years as wage increases were eaten up by what is the fastest inflation in decades. According to the Office for National Statistics, the figures show how pay for most workers is failing to benefit from what is the tightest labor market in living memory. Hot, dry and windy weather is challenging fire crews from California to New Mexico, with wildfires forcing hundreds of people to leave their homes. Roughly 2,500 homes have been evacuated because of two blazes on the outskirts of Flagstaff, Arizona. The high winds have grounded firefighting aircraft. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Perspective, the markets are performing incredibly well. There's a ton of liquidity in the market. There's a lot of transparency in the market, and the processes are operating incredibly efficiently. You can't look at the daily moves. You should invest for the long term, particularly if you're a retail investor.
Lynn Martin, a spirited conversation in Davos. Good to see her again with Bloomberg as well, of course, holding court at the New York Stock Exchange. No doubt interested in what happens with Mr. Gensler in trading for retail, trading for retail here in the coming months. We welcome all of you on radio and television worldwide, and particularly on the evening on the Pacific Rim. We're going to digress right now from the markets. Futures up 20, Dow futures up 110. I agree with Lisa. It's fragile. I'd note dollar strength this morning. Sterling 121.08. Can't get out of its way. Our definitive coverage of Asia has been led by Stephen Engel. He has had the honor, from the span of Hong Kong and Lord Patton to the turmoil of Carrie Lam, to see modern Hong Kong change. Stephen Engel sat down with the outgoing Hong Kong Chief Executive, Carrie Lam.
Despite some skepticism and cynicism about Hong Kong's future, I remain very optimistic and confident of Hong Kong's future. And one of the reasons for my confidence and optimism is Hong Kong's unique strengths under one country, two systems. Is Hong Kong's high degree of autonomy to conduct her external affairs, particularly on the international arena. So we have the autonomy to set up our own overseas economic and trade offices. We could enter into bilateral agreements on free trade, avoidance of double taxation, investment protection. So I do want to conclude my term by reinstating the importance of Hong Kong's international connectivity and her status as an international city.
But is the damage already done?
Well, yes and no, because if you look at the past 2 years, that is before the fifth wave hit us, for a period, Hong Kong was ranked the world's #1 in terms of normalcy. That is when other countries and places were imposing the stay-home permits and lockdowns and closed the airport and so on. We were by and large operating normally. Okay. But since the fifth wave hit us, and it hit us very hard, particularly in terms of the number of deaths,
We went from 300 deaths
so we
to
have to
9,300.
be extremely cautious. And at the same time, because of the transmissibility of Omicron and the mildness of this virus, then other places are opening up. So by comparison, I'm a person who believes in relativity. So everything is relative. When people are opening up and Hong Kong is still imposing a 7-day designated hotel quarantine, that to a certain extent weakens our position as an international city. But mind you, during my term, while the daily cases were still quite high on the 25th of March this year, I already announced the gradual opening up. In terms of social distancing, it's a 3-stage relaxation. We have done the 2 phases. And in terms of coming into Hong Kong, I lifted the ban on the 9 countries. And then I reduced the designated hotel quarantine period from 14 days to 7 days, and then made other adjustments in the test and hold at the airport, facilitating people to come back. So prior to the 1st of April, and for almost 2 years, the daily arrivals at our beautiful Hong Kong International Airport was a few hundreds. Now it's back to 3,000 plus. So I hope that gradually we're able to progress on this route of normalcy.
At this moment of transition, Stephen Engel joins us in Hong Kong. Carrie Lam will pass the baton of Hong Kong leadership, a different Hong Kong, to John Lee. Stephen Engel joins us now. Steve Engel, I'm absolutely fascinated by Carrie Lam, is a citizen of Hong Kong, someone whose father worked on ships, she grew up poor, to a guy who was a police officer from day one for the Chinese government, John Lee. How abrupt will the transition be from Lam to Lee?
Well, you could argue from the other side of the coin as well, that could it be any more tumultuous than the last 3 out of the 5 years of her term? Because she, of course, her term coincided with the protests, the national security law, a complete overhaul of the electoral system, and then a pandemic response that was widely criticized for allowing more than 9,000 deaths when they had a couple of years or a year and a half to prepare for that. That was one of her regrets, even though she says she has very few regrets. She did say that she regrets getting more people vaccinated. But you turn the page to John Lee. He's a lifetime police officer, the former head of security. He was her deputy, and he was the only candidate that was endorsed by Beijing to be her successor. And she only served 1 term. Out of all the 4 previous chief executives, not a single one in the past 25 years since the handover from Britain has made it through 2 terms, which they're allowed. It is a difficult job serving 2 masters, Beijing and the people of Hong Kong. She pretty much acknowledged that. John Lee, he has a clean slate. He has a police background. Right. Will it be more of a police state? That's the big question.
Stephen, we've got to get back to the markets, as you well know, but good to catch up and let us not be strangers. Stephen Engel, truly leading all of our reporting in Asia over the decades. Carrie Lam leaves as the leader of Hong Kong. Lisa, we see the shifts on the Pacific Rim. We see the shifts now, and I guess we could center on a Japanese yen of substantial depreciation.
Did you see what they did overnight? That they actually bought a record amount of bonds in order to suppress yields back to that yield curve control. 2.2 trillion yen worth of bonds that they came out and purchased, according to the government records that came out. This just shows how hard it's getting for them. And you've got certain hedge funds betting against them and actually trying to short JGBs. But again, that policy divergence is showing up in the ways that it can. And right now, what you're seeing is that dollar is reasserting its strength, albeit tepidly, but still, we're not getting away from that, Tom, even as people try to come in to buy this dip.
And Kaylee, this is really important in that from the market turmoil of yesterday to today, yes, there's green on the screen, but it's remarkably fragile, isn't it?
It is, and you've already seen that borne out over the last several hours where futures have fallen off the highs of the session. We're kind of just fluctuating here. There doesn't seem to be much conviction, really, Tom, across any asset classes, foreign exchange included. The dollar now fractionally stronger. The yen has been fluctuating since the overnight trade, right around the weakest level since 1998.
Sterling with a 120 handle right at 1.2100 right now. Maybe one of the international indicators with Italian paper as well. But to look at the U.S. market, it's simple, Lisa. I looked at the Bloomberg total return indices and bonds yesterday. They had a bad day.
They got hammered. You can say that. They got absolutely hammered, and particularly in the credit space. This is a new trajectory. At what point does the Fed take notice of that? At what point does that kind of create a bottom in some way because they have to respond, Tom?
Was it a cathartic hammering?
It was a cathartic hammering. Highly cathartic.
Hey, at a loss for words as well.
Tom Keene,
Stay
speechless.
with us.
Yeah.
This is
We did
Bloomberg.
it.
Good morning.
The market's convinced the Federal Reserve is going to become more aggressive.
If they're going to do 75, it's better to do it sooner than later.
The Fed doesn't have much reason at this point to slow the pace of rate hikes.
For the next 6 to 12 months, things are going to be much more challenging.
We still think the base case is no recession.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. It is a Tuesday before a Fed Wednesday, and it is extraordinary. The market turmoil yesterday, and in some ways different, but continues today. Kaylee Lyons in for John Ferro. Lisa, the character of the market this morning, different than 24 hours ago.
It is. It is more constructive than it was 24 hours ago, where it felt like it was in free fall. But it is fragile. There is a feeling of a lack of conviction and a lack of full understanding of what exactly happened yesterday. We saw a sell-off unlike what we have seen in a long time. Is it capitulation? Is it forced selling? Is it just buyers stepping away? People trying to parse that, but we're watching the end of a low interest rate era in real time.
Lisa, I'm going to call it Tea Leaf Tuesday, getting away from 75 beeps, 100 beeps. Lots of the tea leaves, folks. We have Bloomberg Launchpad. Kaylee Lyons is different than John Ferro's. Lisa's is different than mine. We all have our own red and green blinky Bloomberg. This is why people spend 20-some thousand a year to get a terminal. This kind of flow into us. And I'm looking at my tea leaf this morning, Lisa. Sterling, 120.89. John Ferro may not be able to afford to return from Capri.
Well, we'll see if he decides to, although he is paid in dollars. I just want to let you know that. What I'm watching right now is actually the spread between 30-year and 10-year Treasury yields, which has turned negative yet again for the first time in years. In more than a decade. I find that interesting, this sort of long-term gloom, not to be gloomy, but a long-term feeling that we could not be growing all that much. And this flight to safety in the longer term with such uncertainty in the near term.
In 30-year, that's price up, yield down, worrying about economic growth out there somewhere?
It's a lesser high than 10-year yields, which means that people are expecting growth to be slower over the long term and inflation to be slower over the long term and seek that haven.
Kaylee, what do you see? I want to get to our guest here. What do you see here? And then I'll do a quick data check.
Well, to Lisa's point about those long-term growth concerns, just take a look at the Bank of America Fund Manager survey out this morning. Stagflation fears at the highest going back to 2008. Profit expectations at the lowest since 2008. Global growth expectations at the lowest on record. What does Bank of America call it, Tom? The summer of Volcker.
Summer of Volcker. Claudia Sahm pushing against that, saying this is not a Volcker moment. There are too many differences now from 1979, 1980. One of them, of course, is a bond bear market. A bond bear market is price down, yield up, and we see that with a vengeance. 3.28 on the 2-year yield, 3.29, almost inversion right now on the 10-year yield. Lisa will give you a great perspective on that. The VIX is critical to me, a 30 breach, not to 40, not to catharsis, but 33.48 today with futures up 15. Dollar strength, DXY 105, Bloomberg Dollar Index, a deeper index, confirming that yen 134.32, euro 104.36, and sterling stunning 120.89. We need a brief. Lisa, brief.
8:30 a.m., the latest in a series of data having to do with U.S. inflation. PPI, the prices that factories pay for goods, coming out for the month of May. The expectation is for a reacceleration because of what we saw in the CPI report on Friday. Food prices, energy prices climbing. How does this pass along to margins of companies? They can't pass along the price increases as much as they could before. That is the anecdotal evidence.
Do we see this turn into even weaker margins? At 11 a.m., President Biden is going to dovetail the message into the labor market. Speaking at the 29th AFL-CIO Quadrennial Constitutional Convention in Philadelphia, Pennsylvania, how much can he pivot to the strong labor market in the face of $5 a gallon gas? And this is what a lot of people are focused on, really shaping the sentiment of many consumers. And today, the Fed is kicking off that two-day meeting to discuss interest rates. I'm watching that 2-10s yield spread. How much are we looking at a baked-in scenario of recession that we have to respond to? And at what point does a faster-than-expected tightening cycle actually end up giving the market support, because the Fed is trying to get ahead of what we have already seen the market try to do for it?
We do economics, finance, investment, international relations, and politics. And the foundation of this, particularly in investing, has been trading, whether trading is for short-term, trading is for long-term. We're going to change the show right now, and we can do that with Katie Kaminsky, Chief Research Strategist, Alpha Simplex, who's having a killing year shorting the space. Katie, I want to go back to what you've got tattooed to your brain from the CTA crew, which is anti-martingale theory, which is when you're successful, you increase your bets. When you're not, you have your bets. Are you utilizing, in your record year of getting shorts right, are you utilizing anti-martingale theory to take bigger short bets?
I'd have to say yes, in the sense that we do really well when things are difficult, when there's dislocations, and when people don't know what to do. And that's exactly what's happening this year. We have complacency, we have denial, and we have fear. That is a perfect scenario where markets can be a little bit more behavioral and less efficient. And thus, following the trend is actually a very diligent and less emotional-based way to actually trade such difficult markets.
Are you able, and I'm thinking of the work of Wells Wilder of the late 1970s and looking at something mumbo-jumbo like ADX DMI, does Bitcoin trend? Can you guys take a short on Bitcoin and extend it out here at 22,000 right now?
So I have to admit, I don't trade Bitcoin because I'm a risk manager and there's just a lot of risk there. But what I would say, if you did look at a trend signal in Bitcoin, is that it's definitely gone down quite a bit, but you might need to see a little bit of recovery before we would actually consider that we're having a new trend. I mean, I think that is a very difficult call, but it has significantly reverted from what would have been its previous highs.
Katie, when do you know to close out your shorts?
So we have a process where we're very much about focused on seeing confirmation in data. So if I give you an example, people have just been calling this peak of inflation. We say you can't call a peak until the peak is over. And so I think this is an example. People were too early to call the peak in inflation. We're going to start calling those type of peaks when we actually see that the market confirms that they are going down, or that prices are going down.
So, Katie, if it's too early to call the peak in inflation, is it too early to call the bottom in the equity market?
Certainly. Unfortunately, that's the case. We need to see more confirmation that we're kind of starting to see some sort of recovery. I think it's easy to react on one day's moves, particularly a day like yesterday. We may have some reversal, but we do actually really need to see some confirmation instead of just reacting to one day.
So what are you looking at specifically in the data to indicate that we are seeing peak inflation? You're saying you have to look for confirmation in markets. What are those signs?
I think the biggest things that we look are empirical trends in asset prices. And what's interesting right now is that you're seeing very, very similar patterns to what we saw during a rising rate environment. And I think what you said earlier in the show about, is this the true bottom of the falling interest rate environment? What we have seen is that we're going to tend to be short in a rising rate environment, particularly when we're going close to an inversion type point, where we're moving into a more recessionary environment. And those are particularly the technical signals we've seen in bonds. And this is actually quite interesting, because during those environments, our strategies are going to tend to be 70% short bonds. And if we move into that environment, we're going to see a lot more short bond signals over the next few years.
Is it a crowded trade? I mean, you're in a trend-based, clearly you've hit the ball out of the park this year, but are you concerned that everybody's on board with Katie Kaminsky?
I mean, that's always a question when you're a trend follower. If you follow the trend, you got to get out the doors. But the truth is, very few people are comfortable shorting bonds. And very few people have been comfortable with the trade we've had this year. And that's, I think, why it's been such an interesting year to be a trend follower, because we're doing things that haven't worked since 1994.
Very quickly here, you levered up. I mean, come on, nobody's listening, Katie. You can tell me, are you 3-to-1, 20-to-1? Are you doing a 1998 redux?
No, I mean, we're definitely risk managers in the sense that we run at about 12 vol, which is much lower than what you'd see in the S&P if you looked over a long horizon. I think it's about diversification and finding opportunities across the entire spectrum of bonds, across a large geographical region, and really sort of following macro trends with an eye to many different trades.
Katie Kaminsky, thank you so much. Greatly appreciate it. And congratulations on getting so many facets of this market right. Lisa, we got to go to what we do, which is not trend trading and not CTA work, but just looking at the Bloomberg total return indexes. And I'm sorry, the phrase logarithmically, folks, on the y-axis is yesterday was jump condition.
Yes.
It's stunning to see some of those series.
It's a new regime. I keep saying this. We don't know when we see the peak in yields. We don't know when we've seen the full reset, what the scope of it is going to look like if suddenly the market is pricing in the end Fed funds rate, the Fed funds rate peak of 4% or north of that by next year. How does that reset valuations that have gotten accustomed to a 0% Fed funds rate? This is uncharted territory in a way that so many people are unprepared, and you're laughing. Why are you laughing?
Oh, the language today is just too much. I've gotten more mail on cathartic puke than anything I've done in 3 years. Kaylee, say something intelligent while I give Lisa the number she wants.
Well, as I listen to Lisa talking about all the uncertainty out there, all the things we do not know, maybe that is why we see so little conviction in the market this morning. What does an investor do after a day like yesterday, as brutal as it was, an S&P 500 in bear market territory? What do they need to see to have the confidence to dip their toe back in? Because that confidence looking at futures, Tom, seems like it's waning as we get closer to the opening bell.
Lisa, I just did the Bloomberg Total Return Index drawdown 16.9% in the IG world.
These are bonds. They're supposed to be safe. These are supposed to be areas of capital preservation. And you're starting to see the outflows. You saw that from LQD. It's the biggest investment grade high bond index. And you saw record outflows.
When you say bonds are safe, my grandfather would throw his blue Standard & Poor's bond guide at you. They are not safe. Futures up 9. Stay with us.
Keeping you up to date with news from around the world with the First Word, I'm Ritika Gupta. President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman, according to an NBC report. No immediate comment from the White House. Biden once promised to punish Saudi Arabia over its human rights abuses. The possible trip indicates his drive to lower gasoline prices and isolate Russia over its Ukraine war. The spending power of UK households fell the most in more than 20 years as wage increases were eaten up by the fastest inflation in decades, according to the Office for National Statistics. The figures show how pay for most workers is failing to benefit from what is the tightest labor market in living memory. Hayes Fan, a member of Bloomberg News' bureau in Beijing, was released on bail in January, according to the Chinese embassy in D.C. It has been more than 1 year since she was detained on suspicion of national security law violations. Fan's case is said to be under investigation. Bloomberg editor-in-chief John Mithgoldthwaite said, quote, "We will continue to do everything possible to help her and her family." 2 Wall Street banks are withdrawing from handling trades of Russian debt. The Biden administration said last week it's banning U.S. investors from scooping up such assets. J.P. Morgan Chase and Goldman Sachs were still matching sellers who wanted out of the debt with buyers. The U.S. Treasury's Office of Foreign Assets Control says U.S. investors aren't allowed to acquire them. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Fed says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But what's next?
Some big questions about the next move, the one after that, and ultimately the destination.
Maybe they can let the high prices naturally bring down demand.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
Think about it from a trading perspective, what's been missing the entire last several months is sort of what I would call a cathartic flush out, where you get the VIX above 40, which is one of the things you need for at least a trading bottom. This week is fraught with peril.
Julian Emmanuel, the interview of the day yesterday, linking in his equity and quantitative work at Evercore ISI with his boss, Edward Hyman. And Julian Emmanuel making clear that Ed Hyman is looking for a settling of inflation at a 4% level. That is a different statistic. Adamant they don't see a recession out there right now. Lisa, we got markets on the move. Before we get to our correspondent in Washington, BitDog just revisiting 21,000 handle here, giving way, and I'm looking at sterling, a 120.80, 1.2080 is maybe the currency of the moment. What do you see?
I would agree with that, considering the fact that it's breaking down to the lowest levels since the heart of the pandemic, and this is on some of those real wages that we saw earlier. I was watching just the futures fading, bouncing around, trying to get a bid, trying to regain a little bit. It's not that active today. There is a lack of conviction. People are trying to retrace some of the moves, but again, it's not a wholesale buy signal, and that alone tells you something, Tom.
Brent crude up $1, 123.23, about $1 below recent highs. Kaylee Lyons with us as well, in for John Farrow today, and again, our Fed coverage tomorrow. Right now in Washington, Anne-Marie Horton joins us. Anne-Marie, it seems like the polarity is so stark in Washington, the hearings and all that, that I don't know where the middle is. Where is the middle, the centrist candidates of both parties right now? Are they hiding in a bunker?
Well, it's a good question, but I do think, Tom, you are seeing potentially one place of middle, one place of compromise, and that's going to coalesce around this gun legislation or the potential for this gun legislation. It is certainly not as far, and certainly not as far as Democrats want to go. We heard that from the president himself. But at the same time, 10 Republicans are signing their names, and what we're hearing is that ironclad, they want to go for this, and that could potentially get passed through the Senate. That would be something that has taken years for Washington to get around. So there are moments, while I know we always see a lot of partisan hype, there are these pockets of potential bipartisanship in Washington. And I think at this moment, the drafting of this gun legislation, the potential vote of that, could be one.
Anne-Marie, this administration has been throwing spaghetti at the wall, trying to see what sticks in terms of how they're grappling with inflation, whether it's good because of the labor market that's strong, how it's bad, but it's not their fault. What's going to stick? How is this going to really be shaped today at the meeting and the speech that President Biden is giving in Pennsylvania?
So speech today really is going to be about the audience he's talking to, right? So it's going to be about, quote, good paying union jobs, something the president has constantly talked about, building the economy from the middle class out. But Lisa, you make a very good point. They have thrown policy, communication, spaghetti at the wall to trying to see what sticks in terms of inflation. Is it the Fed's fault? Do you pass the buck to Jay Powell? You deal with it? Are we going to see obviously higher interest rates and then potentially lower inflation? Is it Putin's price hike? Is it the issue because we've had such a robust recovery and now a tight labor market? They are obviously trying to get through to the American electorate, which poll after poll shows that this is their number one concern, and not just a reminder of the polls, but every day when you walk or drive past a place to fill up your tank, you're reminded of that inflation every single day. And today, that number is north of $5 a gallon.
How much are Democrats cutting off President Biden as the likely nominee for the next term, but also just as the leadership, trying to find another compass in order to reset for the broader party and not just what President Biden is facing in his poll numbers?
So two things. One, there was that New York Times report recently that talked about the fact that Democrats are weary about President Biden running for a re-election of the presidency in 2024. Not a lot of it is being communicated in public, but this is the talk behind the scenes. But then, of course, you have just yesterday the press secretary saying, of course, the president plans to run. Biden himself saying he plans to run in 2024. This would potentially likely become a little bit clearer, I would say, after the midterm elections.
Amory Horton, got to leave it there with markets on the move. Amory Horton in Washington, an eventful June in Washington. Lisa, very quickly here, sterling just plunges. There's no other way to put it. Down to a 120.68, just giving way.
And this has to do partly with the dollar that's reasserting some strength and actually solidifying that strength in both the DXY and BBDXY, the Bloomberg broader version. This after initially there was a bit of weakness. The strength is not a positive, Tom. I think that we can say that for the rest of risk assets, when the dollar is strong, it indicates that everything else is being thrown out and people are seeking safety in what they know.
We're efforting people here, folks. Dominic Constant-Mazzullo will join us, I believe, next week sometime. I'm not sure on that. Or is it tomorrow? Thank you, Amy. They're in my. It's the gerbil in my ear here, folks. Tomorrow, Dominic.
Is it a gerbil?
Dominic Constant tomorrow. Was that Kaylee or Amy? I can't keep track. Dominic Constant tomorrow as well. We're efforting David Folkerts-Landau, who is way out front on this as well. Now, Lisa, as you know, and folks, this is very important. I usually don't speak to anybody before the show. I'm so deep in my preparation. But one of my people told me that the only reason Kaylee could appear today was without a massive plug for crypto surveillance. Look for that this afternoon at 1 p.m. And I mean, you gotta start out. Yesterday, Business Insider, Kaylee, has Scaramucci, runs a wine bar in Davos, Scaramucci out, reaffirming to 100,000 out like 1 year, 2 year, 5 years. Who knows? How do you approach the Bitcoin game this afternoon, Kaylee?
Well, the faithful are always going to remain faithful in large part time, but there are a lot of people who are now questioning their faith in cryptocurrencies because even beyond the broader macroeconomic environment, the tightening of policy, the selling in risk assets really across the board, there are also exacerbating factors in the entire DeFi space right now. The collapse of projects like the algorithmic stablecoin Terra USD, Celsius freezing withdrawals yesterday.
What is a stable coin?
It is in theory a coin that is pegged 1-for-1 to the US dollar. But as we have seen in recent weeks, Tom, that doesn't always work. This is a serious breakdown. We're going to break it all down. Me and Matt Miller, 1 p.m. Eastern time. I know that's usually the surveillance now, Tom, but I would hope you'll be tuning in.
Take a window here. MicroStrategy, I think it's called. When do we see margin calls, loan covenants, and that among all these players, these gazillionaires that are less gazillionary now?
Yeah, potentially below 21,000 for MicroStrategy. We're not too far from that level right now.
Gazillionary.
Gazillionary. They had gazillions. Now they got less gazillions.
For my language, gazillionary.
It's a cathartic gazillion.
Talk about cathartic puke. Let's look at BitDog. Maybe you should change the name of the show to that. This afternoon, crypto. Look for that. Futures up 17. Stay with us. This is Bloomberg. Bloomberg Surveillance. Good morning, everyone. We've got an exceptionally important guest coming up on the global financial system. Mark McCormick, encyclopedic here on Japan and the risks that Japan faces. I want to get to that. I'm going to do a data check at record speed. Kaylee on the individual stocks. The VIX 33.50. I can't say enough about the fragility of futures up 15, Dow futures up 81. It's really not there. Bitcoin moments ago giving way nicely under 22,000, 21,900 right now. Yields are all over the map, 3.30% on the 2-year yield. Dollar strength is indicated by a 105 DXY. And we're watching sterling just as a story of the moment. Sterling 120.90 has just had a difficult morning of it. Let's get right to individual stocks. Ms. Lyons, what do you have?
Well, I'm taking a look at some of those big technology players because, of course, that really drives the direction of the equity market in either direction because they are heavyweights, and it was tech that bore a lot of the brunt of the selling yesterday. But you are seeing somewhat of a lift for some of these. Of course, the ARK Innovation ETF really is the flagship for growth and high multiple stocks. Cathie Wood's flagship fund. It is down 20%, not on the year, not even on the month, over the last 3 days, Tom. Big decline yesterday, though. It's up about 1% in early hours this morning. Tesla's up 0.8, recovering some of yesterday's losses. Apple is up about 0.6%, but all off the pre-market highs as we've seen some of that conviction in the buying earlier on in the session giving way. A couple other more idiosyncratic movers to keep an eye on. One is Oracle. This is actually an earnings story reported after the bell last night. Revenue topping expectations thanks very much to the cloud and strong demand in the database business. That stock is up nearly 12% as a result. Then we have news on Twitter. Elon Musk is finally going to talk to Twitter employees at an all-company meeting on Thursday. That was reported overnight. The stock is up 3.3%. Still, though, just at $38.25. Remember the offer price? $54.20.
So
there is a wide gulf.
The 54 number's still like there.
It's still there. Technically, that was what was signed, sealed, and agreed on, Tom. Maybe Elon Musk is trying to change that now as he's continually kind of pushed back on this deal, raised an issue with bots. Remains a question of whether or not this thing is actually going to go through, but maybe Twitter employees will get a little bit of insight, as will we, come Thursday. And finally, we were just talking about it earlier, MicroStrategy. Michael Saylor has a lot of Bitcoin on the balance sheet of this company. There is now concern that Bitcoin below $21,000 would mean a margin call for this company. After a 25% decline yesterday, it's down another 8% before the bell this morning.
Kelly, thanks so much. I haven't mentioned it, and I've been remiss. Dollar loonie is 129, and 130 on Canada would be something. Right now, from TD Securities, someone who looks at all currencies, someone who's been dead on about dollar resiliency. Mark McCormick is our global head of FX strategy. But we're going to do something different this time, folks. Get out your pens and paper and take notes. Replay the video when you hear it. Mark McCormick, a primer on Japan. Mark McCormick, what yen level does Japan need where the system falls apart, this rigged system of modern monetary theory that they have?
Well, thanks for having me. Yeah, I don't think it's a particular level. I think we're getting to the point now where you think about, is there a level you'd like to fade dollar yen, given the fact that JGBs are moving, all these central banks are moving, everyone's imported inflation from around the world, and we're trying to sequence which central banks are moving. It looks like the ECB is ready to move, the S&B is ready to move, and the major question is when does the BOJ go? I think it's not coming in the next month. It's not coming this week, but I think we should be priming ourselves that 135 is probably a top in dollar yen. And we want to think about what level in terms of maybe medium term or longer term fair value do we get to. The biggest long-term trade in terms of valuation is dollar yen is the most overvalued currency in the G10. So if we think about that things over quarters, I think a level that's important is probably 115 to 120 to think about what is an anchor point for dollar yen relative to the policy expectations.
How do you and your Asian team envision you will migrate from 135 to 115, 120, or even stronger yen, a lower statistic? Can it be smooth reaction functions, or is it a mess in jump conditions?
It's absolutely the latter. It's jump conditions. It's definitely a mess. I would say a big part of it is there's some interesting things that are driving yen that I don't think a lot of people spend their time on. And I think one thing most importantly is the movement in energy prices. And Japan is a massive importer of energy and other commodities around the world. So Japan's current account surplus has been eroded. Yeah. And at the exact same time, there's a tremendous amount of foreign direct investment by Japanese corporates out of Japan, which is also weakening the yen. The question is whether or not moving BOJ policy and the change in the U.S. equity markets and the markets, people leaving the United States equity markets and looking for things that are cheap, undervalued, and underpositioned. This is what can help turn the ship for the yen and then say the next 6 months. This is not, again, an immediate risk, but this is kind of that nonlinear effect. If the BOJ moves, U.S. equity markets rolling over, and people are looking for other places to put their money, Japan is going to flag really well on that outlook maybe in the next 6 months or so.
I can't emphasize enough, Lisa, how this is not your father's Japan. This is not about Toyotas and Toshibas. It is a changed Japan, and obviously because of China.
Obviously because of China and also because of the Bank of Japan's potentially futile effort to control a bond market that can no longer be considered a market. Mark, at what point is the Bank of Japan fooling itself, continuing to buy bonds now at a record pace in order to keep yields pegged at this ultra-low level?
Well, they're still they're still doing it now. I think, again, they're kind of getting to the point where the cost benefit doesn't work in their favor. They tried this again earlier in the year when we were talking about terms of trade shocks and higher interest rates and why would the BOJ continue at yield curve control, and they continue to do it. I think what we're starting to see is the rhetoric's changing. There's mixed messages from policymakers. They're trying to coordinate a policy response between the BOJ and the Ministry of Finance. So there's scope here that the boat is turning, and markets are sniffing it out. So I think this is, again, an interesting concept that the policy itself is broken. Markets know it's broken, and they're starting to actively try to find ways to push against it.
So, Mark, how big would the move be in the yen if the Bank of Japan were to abandon the rate peg?
It would be significant. Again, it'd be a knee-jerk. Again, we're talking a lot about, people are discussing intervention. I think intervention is less palpable than the actual policy change. But if we see the policy change, it could see, knee-jerk could be 5%. In the very short run. But again, a lot of it will hint back onto where we are in the global market cycle, where's risk appetite, where are we at relative to the Fed and other central banks. But the knee-jerk could absolutely be worth a significant move in yen.
Okay, so on the subject of risk appetite, Mark, is that more so what has driven the recent bout of strength in the dollar rather than expectations of tighter Federal Reserve policy?
I think that's a great question because a lot of this year, people have focused on relative themes. We've talked a lot about terms of trade, growth, relative central banks. What's happened since April, and we even got a little sliver of it last month, is people gave up on the broader themes. And what happened is that the dollar and the Fed became all-encompassing. And what the Fed has done through tightening financial conditions is created an equity recession. And risk sentiment has deteriorated, along with kind of the focus on China zero COVID, what's going on with Russia and Ukraine, and how it impacts Europe. But essentially, we're back to that trade now. We're not kind of thinking about terms of trade. You're not buying commodity exporters. You're actually just saying, I'm selling commodity importers like euro, yen, and a couple other currencies. But what's happening is the strength of the dollar is a single meta theme that is basically deteriorating risk sentiment. And what we're doing is bringing short-term cash back into U.S. dollars. So it's really like a one-trick move here where stronger Fed policy, tighter financial conditions, just as a single strong dollar with really no other themes happening in FX.
Well, and you mentioned the headwinds also facing the euro and Europe more broadly. How realistic is parity?
I think parity it's definitely a lively discussion. I think, again, if you were to look at option pricing, which is an interesting way to look at things, in the next 3 months, it's still only about a 15% chance that we hit parity. I think, obviously, we have a trade on. We're looking to revisit those lows under 104. I think the prospects of parity, though, are challenging in this environment because we've already seen the Fed be priced now for 75, 50, 50, and we're already back at a 4% terminal rate.
Mark, well, I got to leave it there, Mark, just because of time. Mark McCormick, thank you for the primer on Japan. Really, really appreciate it with TD Securities this morning. Lisa, I've been waiting for somebody to publish on what happened yesterday afternoon. Nick Timiraos of the Wall Street Journal went on Scott Wapner's show over at the Death Star and talked up the idea of 75 beeps. You know, the whole world went basically a frenzy here. And Peter Bookvar is out now with a carefully considered note, Lisa, calling Nick Timiraos the new John Hilsenrath, the new Fed whisperer. I think this needs a translation for our listeners and viewers who are going, what? But they're using the journal as a conduit.
And that's been a traditional conduit, that they've had one reporter that they go to, that they give information to ahead of a meeting to direct markets away from what they might be doing. Tom. Exactly. What this signals to me is that the Fed is watching very carefully what's been developing in markets, and they want to weigh in, but they're in their quiet period and they can't. It is notable that a lot of the turmoil has happened when you do not have the Fed representatives jawboning up a storm. And how do they get a message out? They take this seriously, they are shifting, and they're going to move in an aggressive way, Tom.
Well, okay, but are we talking about 75 beeps tomorrow?
Well, that's a 50-50 chance right now if you look at markets. If you want to do the parlor game that I know that you love so much, the Fed parlor game, you want to play it? Let's play. Citigroup just publishing moments ago, Andrew Hollenhorst saying that a 75 basis point rate hike is a real possibility at tomorrow's FOMC meeting. But we think a 50 basis point rate hike is more likely. At what point do they have to stop promising action and just do it?
Well, yeah, I'll go with that. They've got to. Well, first of all, they're doing it right now. They've got the path underway. It's just you speed up the path, and there's different arguments either way as well. I mean, Kaylee, I look at this, and I guess we don't have to talk about Bitcoin right now, Kaylee, but we can talk about the parlor game and the likelihood of 75 beeps tomorrow. To me, it's all silly.
Well, but you have a string of economists on the street lining up behind 75 basis points tomorrow. You have Goldman Sachs saying not just tomorrow, but 75 again in July. Nomura saying the same thing. We already had Barclays and Jefferies out with a 75 call. And when Michael Feroli of JP Morgan made his call for 75 tomorrow, he said it is a non-trivial risk that the move is actually 100 basis points. This is the reality we're talking about, Tom.
Stay with us tomorrow after the crypto show at 1 o'clock today. The Fed decides in the 1 o'clock hour tomorrow. Futures up a fragile 7. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden in an Oval Office meeting last week with key members of his cabinet indicated he's leaning towards removing some products from the Trump administration's China tariffs list, according to an Axios report. With inflation at a 40-year high, the Biden administration is looking to show action on bringing prices down. Hong Kong's outgoing leader Carrie Lam says the city's quarantine measures have weakened its position as a financial hub. In an interview with Bloomberg TV, Lam pointed to the fact that Hong Kong is still requiring 7-day quarantines for incoming travelers. Still, she says it is unlikely at the moment to allow people to quarantine at home. And Beijing has meanwhile reported the highest number of daily COVID-19 cases in 3 weeks. 74 infections were reported on Monday. That's the most since May the 22nd, when the capital hit a record for the current outbreak. The nation's top official for pandemic control, Vice Premier Sun Chunlan, is urging Beijing to control the outbreak as soon as possible. South Korea's top diplomat says that North Korea has completed preparations for a nuclear test after talks with Secretary of State Antony Blinken in D.C. South Korean Foreign Minister Park Jin said the North would pay a price if it moves ahead. The test would be North Korea's 7th. And hot, dry and windy weather is challenging fire crews from California to New Mexico, with wildfires forcing hundreds of people to leave their homes. Roughly 2,500 homes have been evacuated because of 2 blazes on the outskirts of Flagstaff, Arizona. The high winds have grounded firefighting aircraft. Global News 24 hours a day, on air and on Bloomberg Quick Tape, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Significant weak patch in most economic models between Q1 and Q3 of 2023. Whether or not it tips the scales into mathematical recession depends what you're looking at. But the real story is this is a material growth slowdown. And guess what? Whether it's recession or not recession, that's not the name of the game here.
Francis Donald, lights out yesterday with Manulife. Just really great perspective to get us to an update to the Fed decides tomorrow on the 1 o'clock hour. Futures very fragile, up 5. I can't say enough how fragile they are with VIX 33.75. We're watching sterling under a 120 at 1. On a chart, on this inversion, plural, Kriti Gupta.
Yeah, let's start off with the 75 basis point calls, Tom, because as you see in just the last 24 hours, that call has quickly started to become consensus, rolling out very quickly. But let's talk about the implications of it, because one of the arguments to have 75 basis points or even 100, depending on which strategist you're really talking about, is to front load the hikes, get them out of the way, a spoonful of sugar with your medicine, essentially, as we have the Mary Poppins reference. That's really important when it talks about how the economy can actually handle. The question is, can it actually handle those 75 basis points? Folks, for our radio audience, what you need to know is we're looking at 3 treasury curves, the 5s, 10s, the 2s, 10s, and the 5s, 30s. They are all the same color because the spread here doesn't matter. What does matter is that they are all inverted, and it really speaks to the fact that these are all curves that are looked at as this kind of beacon of recession risk, of imminent recession risk. But the question is, if you do have 75 basis points get delivered tomorrow, does that guarantee a recession, or does that guarantee a sigh of relief?
Kriti Gupta with the Mary Poppins lead-in, which is a perfect segue here to Lisa Abramowicz. Because, Lisa, you know, in every job that must be done, there is an element of fun. You find the fun in Snap. the job's a game, including a bond strategist at Columbia Threadneedle. Why don't you bring in Ed, Lisa, right now in your bond universe?
Maybe it's Mary Poppins because you don't know what anyone's going to bring out of a hat. It feels like a very uncertain market. Ed Al-Husseini is global rate strategist at Columbia Threadneedle. And Ed, yesterday there was a question of what was prompting a lot of this selling, because we saw moves unlike what we have seen going back to the depths of the pandemic in March 2020. Was this a lack of selling, a lack of buyers, or just simply a lack of anything going on whatsoever and fear pervading?
Yeah, I mean, I would focus on two things. First, the Fed has done a really good job of trading markets to look for upside inflation surprises and price in a more aggressive Fed. That's a very important Pavlovian reflex at the moment. And that's really a function of the Fed's communication over the course of the past 6 months or so. The second piece is the liquidity. Liquidity is exceptionally thin in both Treasury and credit markets. And so when we have these periods of rapid repricing, the moves tend to be exaggerated. And that's exactly what we saw starting on Friday and into Monday.
Ed, when things move quickly, things break. At what point do you start to see market functioning break down in a way that catches the Fed's attention and beyond?
Yeah, market functioning, again, particularly in treasuries and in credit, and the fact that it's spread to investment grade credit is definitely a yellow flag. This is one of the reasons the Fed brought its balance sheet to bear in March of 2020. It wasn't just to backstop those markets, but to add liquidity. And I think it's a really unhealthy sign that it's happening this early in the tightening process.
Well, it is early in the tightening process. It frankly has barely begun, Eddie, yet we've already seen these markets move so far. We're looking at a 10-year Treasury yield that is north of 3.3%. At what point do we actually see yields moving lower because of the Havian bid, because of growth concerns, rather than higher on expectations of higher Fed rates?
That's the critical question, because so far we've seen the repricing of the Fed tightening cycle being brought forward, a steeper, faster tightening cycle translate into essentially a parallel move in the curve higher. I think that dynamic was very difficult to sustain when you have risk markets getting weaker. I think there will be a point at which we're seeing right now the curve start to invert, but that inversion will become more aggressive and we'll actually get outright bid for the long end of the Treasury curve. When that happens is a critical question. I think what we're searching for here as market participants is really the level of neutral. Once the Fed is priced to go above the level of neutral, historically the safe haven bid returns to the long end. Clearly, we're not quite there yet.
Ed, I want to talk about the direct actuarial assumption, or oftentimes just to plug in, if your bond portfolio is down 12%, you got to find new cash to put in. And this is the cash refunding of pension plans, institutional money that have taken bond market losses. Are we going to have a massive need to infuse cash into defined benefit programs and other quiet money?
It's not clear. I think those programs are quite well funded. The level of funding in defined benefit programs right now is exceptionally healthy if you look at where they've been over the course of the past 15 years.
Yep.
And so there's money to be put to work in fixed income in those accounts. But given the volatility here, there's definitely hesitation to enter the market.
I mean, to me, it's fascinating to see the institutional response to the greatest bear market of all time. What will be that response? How will it be expressed?
The path of least resistance is to look at this market and look at the outright level of yields in high quality credit, look at the level of yields in the long end of the Treasury market. And these are exceptionally attractive entry points for medium to long-term investors. And so the question is, when do you start to step in? I think most institutional investors now are looking for a quieter period. You can't step into this volatility because liquidity tends to be so thin. So once this volatility starts to come down, once we get a little bit more certainty for what the Fed is likely to do over the course of the next 6 months or so, those institutional investors should step in.
Ed, just quickly here, before we have to run, how much does the Fed watch this and decide to pare back its reduction in the balance sheet or support markets in a way to avoid some of that yellow flag that you say with investment grade bond yields?
I think it's an excellent question. In my mind, odds are very good that the Fed will have to stop drawing down its balance sheet much earlier than they anticipate on its current trajectory. When they'll do it, I mean, look, I think it's very difficult to do it while you're still hiking. It sends, I think, a mixed message to the market, but it's likely to happen much earlier than they currently anticipate.
Ed, thanks for the brief. Ed El-Husseini with us with Columbia Threadneedle today. Lisa, I look at the 2, 10, and 30-year bond, and they're all basically 3.32%. I mean, basically, we've brought the yield curve back to a perceived terminal value. Can you imagine where those yields will be if we adjust our terminal rate higher?
Well, and how much of an inversion and how much of, yes, adjusting higher all across the board, but still longer-term pessimism for the shorter-term inflation that's going to prompt a further action. What Ed just said there is jaw-dropping, that he thinks the Fed's going to have to stop drawing down their balance sheet way or sooner than a lot of people think because of the dysfunction that you're starting to see uncomfortably quickly happening in the credit market.
He skirted the question, which I understand, but I'm sorry, the dysfunction, Lisa, is front and center.
And especially when you see things moving this quickly in markets of full faith and credit that are considered safe. I'm not saying I do. I'm saying that some people call them safe.
Yeah, I go Liz Goldenberg 101, the bond giant of Bloomberg. Guess what? Bond, price matters. This is Bloomberg. Good morning.
This is going to be a very different communications or very difficult communications challenge for all central banks.
The Federal Reserve is going to follow the inflation expectations.
The difference between soft, softish, and something else is very fine.
This economy is going to require higher real yields to slow down.
Trying to satisfy the market and short-term inflation outcomes might be the wrong approach.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
A messy end to a low-rate era. Good morning. This is Bloomberg Surveillance on Bloomberg Radio and Bloomberg Television. Tom Keene, Jonathan Ferro, Lisa Abramowicz, John Ferro off. Kaylee Lyons very much in with all of her encyclopedic knowledge. Are we there yet? Have we seen capitulation? And how much further do we have to go, Tom? It is a tepid tape with people trying to buy.
It's a fragile tape. Futures up 7. I really want to emphasize here, Amy, give me the chart if you can right now. Futures have not been read this morning at 2:17 a.m. We had the peak enthusiasm of the day, and it's been, Lisa, a glide path down on the cusp of going negative. But maybe with the president's announcement to Saudi Arabia moments ago, oil pulling back $1 for a moment, and futures getting a little bit of green on the screen.
What I gather from the people who we speak with is a lack of conviction and a lack of understanding of exactly what's driving this. Yes, it was the inflation print on Friday, but what is the response mechanism, Kaylee? And I know that you've been covering this really well. The response mechanism with the Federal Reserve poised to raise rates by 75 basis points, maybe, according to some people, as soon as this meeting. Would that be perceived as a good thing or a bad thing for markets looking for some harder action from the Fed?
I think that's a very interesting question, and frankly, we aren't going to know the answer to that question until 2 p.m. tomorrow, which is probably why you aren't seeing that much conviction this morning. But it does raise an interesting point. If inflation is the problem and you risk running inflation hotter for longer if the Fed is too dovish, does then a Fed that is more hawkish, but kind of hawkish that the market now seems to be giving them permission to be, actually the better scenario? This is definitely, it's a different kind of narrative than one we had prior to that CPI print on Friday.
And Tom, you've been really good about emphasizing how it is a tentative tape. This is not one with conviction. It's fragile. It's been moving around. The dollar is just trying to weaken, with people saying maybe we can move away from this, and yet continuing to reassert its strength versus the pound, versus other areas that people have been watching. How much can we avoid some risk-off environment as long as the dollar continues to be the haven and you see that underlying bid?
Yeah, we don't want to give our opinions here, folks. Buy, hold, sell on anything, but we can look at the drift of any time series and say, what's a conviction? What's a belief? Obviously, everybody, Lisa, waiting for news flow, but you look at the individual items, including sterling, well under 121, 120.83, crude still at a 123 level, exactly 122.98 on Brent, and the flightiness of the curve inversion, Lisa, is remarkable.
Well, yeah, although hovering around that flight flat to negative kind of feel as we look at near-term very high inflation, long-term slower growth. Also watching the NASDAQ, considering the fact that it's up 0.6%, outperforming the S&P. Just to put into perspective, the NASDAQ is down more than 30%, Tom, year to date. That, to me, blows my socks off, considering some of the drawdowns during the 2000 dot-com bubble. We're getting close to that, Tom.
I'm glad you bring that up and that these larger moves are important. Linda Dussel at Federated got us started this morning, and I really want to reframe that into the data check of a correction 10%. My bear market is 18%, but the history of down markets is not 18%. It's much more 25, and even market down to some history moments of 35% as well. On the data check, a dollar resilient, a 105 DXY, yen 134.42, euro resilient 104.49 this morning. Sterling, the lead story, weaker 120.80. Futures bounce off, up 6, now up 14. Dow futures up 82. The VIX 33.64. Lisa?
Yeah, although yesterday was a scary day for some people. That was their words, not mine. I think that people were looking at the nature of selling or perhaps lack of buying and not fully understanding the depth of it. Among those, parsing the tea leaves that Tom has been talking about, Sarah Malek, Chief Investment Officer at Nuveen, managing billions of dollars for your investors. Sarah, what were you doing yesterday as markets melted down?
Well, we're thinking about the next 3 months. We're looking at 3 FOMC meetings and 3 options for rate hikes, 50, 75, or 100. And what that's going to depend on is whether we see signs of moderating inflation or demand destruction. Unfortunately, there's no signs of inflation alleviating. We saw that with CPI, which was up broadly. There are signs of some demand destruction. But the key question is, has the market priced in maximum Fed hawkishness? We don't think that it has. Looking at 2023 earnings of about 250 on the S&P and a below average market multiple, you could see the markets trading down here at about 3,600, likely in a trading range up to 4,200. But we're not going to break one way or another until that inflation starts to moderate, and we're just not there yet.
Sarah, I got to ask you the Nuveen question because you invented it. You own the high ground in Chicago, and that's on tax-free bonds. I mean, in everything you're doing in equities, is the shop saying you need to take advantage of tax-free bonds right now?
Well, the good news with municipal bonds is that the fundamentals are very strong from a state level. It's the macro headwinds of higher rates that have been an issue here. But if you look at total return for areas such as high yield munis, they look really strong here. So that's an area we think is interesting at this point, because once some of these macro headwinds move out of the way, the fundamentals are going to be in place for that sector.
And now we got to ask the unfair question of the day. We do this with Sarah Malek with her focus on equities. Do you suggest within Nuveen research that the tax take of some of these states is going to sustain, or is it a pandemic one-off?
I think that there is going to be some normalization post the pandemic. We're seeing that across the board in a lot of sectors, but it's still going to be a high level going forward. So it's not going to normalize to below average levels. So this trend continues. There is some pain as you go through the normalization. We're seeing that across the board with many companies.
I mean, it's amazing, Kaylee. Sarah Malek just crushed that. I'm asking her narrow muni bond questions, and she just absolutely nailed that.
Well, why else do you think she's on the program, Tom? Because she's smart and she answers our questions. Sarah, a question for you. What would you be buying on a morning like this one?
Well, we're looking across a few areas. Number one, coming into this year, energy was our favorite sector. We like the tight supply dynamics of the sector, strong demand, but importantly, producer discipline. Producers are focusing on returning cash to shareholders rather than on just barrel growth. That keeps the sector tight, I think keeps energy stocks strong for many years. Let's turn to the consumer. A lot of trouble here with Walmart and Target, but for us, that was more company specific based on that lack of spending on goods. Consumer likely trades down, looking at areas such as Costco, resilient subscription model, ability to raise prices for Costco, and also TJX, which is more of an off-price retailer. We like areas. And then you talked about growth stocks earlier. I mean, the NASDAQ's been hit so hard. We're looking for quality, strong companies like Salesforce in that area. Very strong push to digital, strong booking, strong customer growth. And importantly, they're helping their customers grow revenues. And with margins at peak levels, revenue growth and pricing power is going to be key for companies to grow earnings.
You mentioned there Target and Walmart. I guess you think they're more kind of idiosyncratic inventory management issues at the company level than anything emblematic of something broader happening in this economic environment as consumer tastes change. You don't think this inventory buildup, this inability to pass on higher costs for certain discretionary goods is going to be a broader problem, Sarah?
I think that, look at the consumer, they're continuing to spend, they're starting to eat into their savings. That is a risk that we're watching. So there are cracks in the consumer, some cracks in the labor market, higher interest rates, all of that I think is a risk for the consumer. But Walmart and Target, this was an issue of what happened during the pandemic. People were spending so heavily on goods. These companies were having such trouble gathering inventory that they basically overplanned and the spending on goods shifted. We're now spending more on services, more on experiences, and they ran into an inventory problem. And I think that is, while it's a sign somewhat of a consumer macro problem, that was specific to Walmart and Target and not an issue that would be a broad retail issue.
Sarah, thank you so much. Sarah Malik, just there and a real champ to talk muni bonds with us as well, with the Muni Bond House, Nuveen, and all that they do across other asset classes as well. Lisa, I guess this is going to be the next number of days. We mentioned with Kaylee Lyons, crypto expert, MicroStrategy, but there's a headline from Coinbase, which, to be honest, I really don't know what Coinbase does, folks.
It's a crypto exchange, Tom.
But they're going to cut the size of their team by about X%. I mean, Lisa, I think we got to go to Kaylee on this. Folks, look for crypto surveillance today at 1 p.m. Kaylee, we're going to see a lot of this, right?
Well, in the crypto space, you likely will. We've already seen it from a number of companies. And Brian Armstrong, the CEO of Coinbase, in this letter is saying there's a number of things that have changed just over the last month that have led to this decision to cut about 18% of jobs. One, he says economic conditions are changing rapidly. Of course, we know companies across the board are dealing with it. They say managing costs is critical in down markets. Again, that isn't just exclusive to crypto companies. Everyone is having to do that in this inflationary environment, in a market in which it has been absolutely brutal. And finally, we grew too quickly, Tom, is the third reason that he gives there.
Lisa, I'm going to punch somebody.
I just think about back when we were at Davos and we were talking to Scott Minerd of Guggenheim, and he talked about how he had been a bull on crypto assets, and then he saw the sell-off and there was no reason to buy the dip, and he saw it heading to 8,000. And that's looking somewhat prescient today, and we have him on tomorrow for the Fed special, so maybe we can ask him about it. Tom.
Say something, Kaylee.
We're doing this again?
Start
Kaylee.
Screaming.
Tom, would you like to phone a friend? Is there anyone you'd like to call?
Say something smart, Kaylee, so I can look at some charts.
Did they really publish in their press release that they were bad because they grew too quickly?
Yep, this is the quote. At the beginning of 2021, we had 1,250 employees. At the time, we were in the early innings of the bull run, and adoption of crypto products were exploding. ... While we tried our best to get this just right, in this case, it is now clear to me that we overhired.
Do you have a bolt onto the Tang this morning?
Didn't we have? Well, hold on a second.
Does that not sound like Amazon with their warehouses
That's exactly
and employees?
what I was thinking. I'm so glad that you said this. It's not just Amazon. There were also Microsoft talking about that as well. It was a number of companies that expanded and benefited the most during the pandemic.
Futures up 10. Let's do a quote on BitDog, 21,904. Crypto, 1 p.m. Be there. This is Bloomberg.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden will travel to Saudi Arabia in July and meet the country's de facto ruler, Crown Prince Mohammed bin Salman. Biden once promised to punish Saudi Arabia over its human rights abuses. The possible trip indicates his drive to lower gasoline prices and isolate Russia over its Ukraine war. Hong Kong's outgoing leader Carrie Lam says the city's pandemic measures have weakened its position as a financial hub. In an interview with Bloomberg TV, Lam pointed to the fact that Hong Kong is still requiring one-week quarantines for incoming travelers.
Who believes in relativity. So everything is relative. When people are opening up and Hong Kong is still imposing a 7-day designated hotel quarantine, that to a certain extent weakens our position as an international city.
Lam also conceded her government could have prevented elderly deaths with a stronger vaccination drive, but did not apologize. And Hong Kong residents will now have to show a negative COVID-19 test result to enter the city's bars and nightclubs starting on Thursday and running through the end of the month. The decision comes as the city is seeing an increasing number of infections, in many cases driven by transmission at entertainment facilities that recently reopened. Hayes Fan, a member of Bloomberg News' bureau in Beijing, was released on bail in January. According to the Chinese embassy in D.C., it's been more than 1 year since she was detained on suspicion of national security law violations. Fan's case is said to be under investigation. Bloomberg editor-in-chief John Micklethwaite said, quote, "We will continue to do everything possible to help her and her family." Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
The Fed says a 50 basis point hike is coming.
The Fed is telling the markets what it wants them to do.
But what's next?
Some big questions about the next move, the one after that, and ultimately the destination.
Maybe they can let the high prices naturally bring down demand.
Trust Bloomberg for the fastest coverage and exclusive analysis.
The press conference live. McKee in there. It'll be interesting.
Bloomberg Surveillance. The Fed decides. Wednesday on Bloomberg. The fastest way to stay one step ahead.
If they're going to do 75, it's better to do it sooner than later when policy is still at a very low interest rate. But it also goes to the fact that they've kind of lost control of the dialogue over this. I mean, they need a monetary policy approach that they can sustain.
Stephen Whiting, he is with Citi Global Wealth Management, chief economist, chief investment strategist, just wonderful at linking in earnings and profits into the greater picture. We're going to digress right now. This with futures up a fragile 12 after yesterday's festivities. The VIX 33.68. With Lisa Abramowicz and I noting 3.33% 2-year, 3.34% 10-year, 3.334, whatever. The numbers are
whatever.
They're all pretty similar.
They're all the same. They're flat.
They're all the
same. And that's what you're seeing. And
The
you're
yield
seeing
curve is
people bring
flat.
that through. That is a well-said thing.
Did
And
I
you're
do
actually
okay?
seeing it. You did great. And on the longer end, when you look at the 3s, 10s, the 3s, 30s, or the 5, 30s, you're looking at inversion in many pockets that are creating some concerns.
The terminal rate reality is really something here. James Camp joins us now, strategic income at Eagle Asset Management, who's been dead on about higher yields. James, do you just assume the so-called verbiage of a terminal rate moves higher, and that flat yield curve we just described goes from 3.32, 3.34, 3.34, and that migrates up near 4%?
Well, I think long-term interest rates are going to find a footing here, probably around these levels. We did violate the 325, which was the high in the 2018 experience. What I think is happening is the Fed and the markets are tightening credit conditions even more rapidly than the projected funds rate. And I think that's what the market may be missing. You know, with equity volatility, with equity prices, with spreads across the high yield IG space, investment grade space, the Fed is crushing credit conditions. And that is, in fact, I think, part of what they're trying to do. This is full on demand destruction. We got to slow the economy. Maybe we touch recession, but the only way out of this miscue, if you will, in terms of timing of the Fed getting the inflation story right, unfortunately, is to slow aggregate demand, and that's what they're focused on.
James, Ed Al-Husseini of Columbia Threadneedle was just on about a half an hour ago, and he was saying that he could see the Fed stopping the runoff of the balance sheet because of some of the credit conditions, because of how quickly the pace of tightening of financial conditions, particularly with respect to top-rated companies. Do you agree?
Yeah, I think that's possible, Lisa, but I don't think that QE in QT, if you will, I don't think the data is very revealing. I think it's ambiguous at best, the effects of the quantitative tightening or the runoff. And I don't think at this point, given what's happened with broad risk markets and what's happening with the inflation data, there's really any choice. The Fed's left it no good options. And unfortunately, we're going to have a couple quarters of this, and we'll see what happens thereafter.
So right now, do you buy into this if you're looking for income, considering that you're getting income the likes of which you haven't seen since 2009? Or do you step back because there's nothing that's going to stop the runaway sell-off in the very near term?
No, I do like the income markets. I like the fixed income markets. I like quality. I like treasuries here. I think spreads still have room to widen, including high yield. I think the municipal bond market, for those in the non-qualified world, those looking for tax sheltered income, probably have some of the most generous yields they've had in a number of years. And by the way, July, Lisa, is, as I know you know, will be a massive redemption, massive cash flow month. And I think we're going to reverse the big negative outflows for municipals. So the income space and fixed income is very generous, as you mentioned. We were 40 basis points on the 10-year just two and a quarter years ago. So it's a pretty extraordinary move.
And you say you like treasuries here, that there may be value now that yields are north of 3.3%. When do you think more people are going to come into that camp, James?
Well, I think it's close. And obviously the risk market's having these massive hiccups, being in a correction full stop in S&P and the NASDAQ, that you're going to get sort of this rotation and flow of funds data, I think, comes back into the bond market. Ultimately, as we've thought, the Fed now no longer being the indiscriminate buyer, in other words, every month coming in with $120 billion, yields were going to have to find a place where real investors, real hard dollar investors were interested. And I think that's upon us right now.
James, thank you so much. James Camp of the Eagle here on the yield here, 3.31, 3.33, 3.34. I think it's a flat yield curve. I just looked at the weighted average cost of capital at Coinbase. And Lisa, I'm telling you, I guess it's trouble. They've got a 9-year piece out as well, the 3 5/8 of 31, and it's yielding near 11%. And Kaylee Lines is down 41% in price from September. I mean, Kaylee, is Coinbase a going concern?
Well, possibly. I mean, that's not the only price that's going down, Tom. You also have Coinbase shares that are down dramatically over the year. They're down another 7% or so this morning after this announcement that they're cutting 18% of their workforce. And the CEO, Brian Armstrong, literally saying, we grew too quickly. We were too aggressive on hiring. And now that the environment has turned to one that was bullish to one that is quite bearish, a crypto winter, as you call it in this space, things have to change. And what that translates to for Coinbase is cutting 1,100 employees. But even outside the crypto ecosystem, Tom, this is something we've heard from other companies.
This is a drag. Lisa, help me here. I wish Ferro was here. He'd go, what in God's name is a crypto? Lisa, what is a crypto ecosystem beside a made-up marketing phrase?
Look, you can call it whatever you want, but a lot of people bought into it. And with Coinbase, it's not just the average Joe or retail investors that bought into it. It also was institutional investors, and it was also individuals on Wall Street who wanted to leave Wall Street to go to the crypto universe, to the ecosystem of crypto magic. And a lot of those people, actually, a number of them saw their jobs revoked at Coinbase just recently. They left Goldman Sachs, they left BlackRock, and then they got a notice saying, actually, we don't have a job for you. So how much were the tea leaves there that things were rapidly shifting for the future of finance as people envisioned it a year ago?
There's a small New York City toothpaste company called Colgate-Palmolive. Do you think they sit around the desk at Colgate-Palmolive talking about the Colgate ecosystem?
I'm not sure how to respond to that, Tom. I mean, these are ecosystems. That's how you talk about them. It's an emergent ecosystem. That much is abundantly clear in that you're starting to see some of these projects that people had a lot of promise, a lot of hope in, completely devolving. Lisa?
You know how you answer that? You really want me to talk about toothpaste ecosystem in response to the Coinbase and the crypto asset ecosystem? Really?
Do you see, Lisa, how Kaylee gets totally engaged about crypto?
Well, she should. Well, she has a great show, and it's a great moment for it.
What are you doing today on the show, Kaylee, within this bombing? What do you got today?
Well, we're going to talk to one guy who called the asset freeze withdrawal of Celsius, the man, Mike Alfred, over. Will be speaking with us, and Nick Carter as well, who's a big voice in the space. And we're going to take a look at the technicals, too, because they matter in this ecosystem a lot.
Great. John emails in from Capri. Enough of BitDog. This is Bloomberg. Good morning. Good morning, everyone. Bloomberg Surveillance. Lisa Abramowicz has been talking about regime change, and one of the regime changes of this regime is we look back at an old kind of inflation that we used to stop 20 years ago and say, we have to look at this. Michael McKee now stops and takes a look at business inflation, the three levels of PPI. Michael.
Well, PPI is just going to add to the pressure on the Fed. The numbers come in about as expected, which is a little bit of a dip in the headline, but not enough to get anybody excited about inflation going away. We see an 0.8 rise on a month-over-month basis. That's higher than the 0.5 rise last month. But because of base effects, we see a year-over-year rate of 10.8%. It was 11% last month. So the year-on-year headline dips a little bit, but with the PPI like CPI, we want to look at the core. And excluding food and energy, we were up by 0.5. That's more than the 0.4 that we had seen. And that means an 8.3%, down from 8.8% base effects. But with the PPI, we add in trade services, which is basically, if you want to look at it this way, it's essentially retailers' margins. It's what they're having to pay for the goods that they buy and then sell on to you. And including that, we were up 0.5, which is a bit of a drop from 0.6 the months before, 6.8% on a year-over-year basis. So the news is, marginally better, but it's not going to change what the Fed is thinking tomorrow, especially with CPI and those numbers coming in, Tom, on the Michigan numbers and New York Fed numbers for expectations.
Lisa, do the markets move?
A little bit. I mean, it's a marginal move, to Mike's point, a marginal downside surprise, the one you kind of want to see. It is not coming in as hot as people expected. The NASDAQ in particular, climbing 0.8% ahead of the open in futures, the S&P up 0.5%. Two-year yields just slightly touching 3.28%. So really kind of just a little bit more of a bid to the bond market. And then the dollar, you saw it soften just a touch, but really, Tom, showing that it's really people are looking for any sign of relief from some of the worst case inflation runaway kinds of projections.
I got a 10.8% PPI final demand year over year. Michael McKee, is this the first look at double-digit inflation?
Well, no, because it was 10.9% last month, initially reported as 11%. We tend to look at the year-over-year figures because it's the most dramatic, and those double-figure numbers are certainly scary. But what you're going to look at if you're the Fed or other people is the month-over-month, because you're looking for sequential gains, and that's what we're seeing here. We're seeing the situation get worse. The base effects bring the year-over-year number down a little bit, but we doubled the PPI in the month of May from April. The increase was 0.4 in April. It was 0.8 in May. So things are not getting better. Now, a lot of that is going to be energy, of course, but that's what the Fed's going to be talking about tomorrow.
Okay, I got like 8 more questions. You'll have to do it later. Michael McKee leading our coverage tomorrow. The Fed decides 2 p.m. He will be in the press conference in Washington with Chairman Powell. Michael McKee whispering always at the Fed. Right now, Carl Weinberg with us, chief economist, High Frequency Economics. Lisa wants to dive into the international feel. Carl, I've got to go to your scathing China note. I believe it was yesterday where you say flat out, we can't trust the Chinese data. How close to worser is China?
Good morning, Tom. Good morning, Lisa. China's numbers are surprisingly strong. The trade numbers are surprisingly strong. We can make up a story for the import side that perhaps points to a very, very big drop in the volume of imports, assuming that import prices went up. But the export numbers are just over the top. It's hard to believe that with the ports closed for at least half of the month of May, that we saw a 15% year-over-year rise in exports. So I'm skeptical of the numbers that we're seeing. Of course, we'll get more numbers this week. We're going to see retail sales and industrial production and fixed investment spending at the end of this week. Let's see if they paint a darker picture of the economy, more aligned to what we expect to see.
Carl, do you see anything that's going to put a crimp on the inflationary kind of pressure that we're seeing upward in the near term?
Well, the central banks are going to put a crimp in things.
Aside from them.
Well, but that's really the core story here. Every time central banks have gone out shooting for inflation, they've caused a recession. And almost every time we've seen a recession, we've seen prices fall off dramatically. Few people remember how fast inflation dropped from just before the spring of 2008, the economic peak, until 6 months later, we went from inflation to deflation, and oil went from $140 a barrel to $35 a barrel. Now, that was a really big hit to income, really sudden, really unexpected. But every time we look back in history and we've seen the economy go into a recession or a period of slow growth, we've seen prices slow rather dramatically. So that's the story here. You look at the current data, and it's very fair to say there's no evidence in the current data that inflation is slowing. That's true, but that assumes all other things remain equal, and all other things will not remain equal. The hike in interest rates that we're seeing from all the central banks around the world, except for the Japanese, is going to slow growth, and that's what's going to bring prices down.
This is incredibly important, Carl, because a lot of people were saying that the only way for the Fed to achieve a soft landing was if other aspects coordinated with it, exogenous risks abated, and allowed a weaker or a slowdown in inflation that was faster than some people had been expecting. If that is not the case, Carl, is it basically, they're going to cause a recession? They need to cause a recession in order to get price control into the market.
Well, Lisa, we heard Fed Chair Powell say a few testimonies ago that the Fed's track record on soft landings isn't really that good, that he could only think of 1 or 2 instances in the last 50 years when they actually achieved one. Maybe this time will be different, but there were 6 episodes of interest rate hikes by the Fed that preceded or were associated with the last 6 big economic downturns in the United States. And we see the same thing for the Europeans and for the English as well. So, that's certainly going to be a factor. The exogenous factors are going to go away. All right, for sure, oil prices are not going to continue to rise. And again, as we saw back both in 2008 and in 2020, if the economy gets slammed hard, oil prices can go from $140 a barrel to $35 a barrel in 6 months. They can fall just as fast as they went up. And that's, I think, got to be part of everybody's thinking.
Well, the thinking goes that the cure for higher prices in the commodity complex eventually is higher prices, that eventually demand destruction will kick in. We have seen sentiment waning, Carl, and yet you haven't necessarily seen the robust demand destruction when it comes to actual consumption, to consumers being willing to spend their money. When does that start to happen in a more robust way?
Yeah, hi, good morning, Kelly. Yeah, we just have to be a little bit patient to see it work out. Right now, we see evidence consumers in the United States are running up their credit card debt. We see evidence that they're reducing their savings. These are all ways to cushion the impact of a drop in real income, which is what's being caused by the higher energy prices and other prices that households are facing. But that can't go on forever. And I think we just have to be patient that it's coming. Everything we know about economics says it's in the works. It's just not here just yet.
What should they do tomorrow, Carl? You've been doing this for decades. You've got tons of experience, back to Arthur Burns and even McChesney Martin. What should Jerome Powell do tomorrow?
Well, I think he's got to pursue the course of convincing people that the Fed is going to do whatever it takes to fight inflation, to not let inflation expectations become entrenched in wage demands and consumer spending behavior. Ben Bernanke had a piece in the New York Times today saying exactly that. And I got to agree with former Chair Bernanke that that's the most important thing that the Fed can do. We've been teasing high-frequency readers with an article from the Economic Bulletin of the ECB from May of 2010, written by the Bundesbank, explaining why Germany fared better in the great inflation of the 70s in the United States.
Right.
And their answer was they established a credible target for monetary growth, a credible target for inflation, and they stuck to it. And I think that's the most important thing that the Fed can do right now.
Carl Weinberg, thank you so much. Great briefing here as we go to the Fed show tomorrow. We'll have that for you in the 1 p.m. hour. Michael McKee in Washington. Lisa, I love this sentence. This is from Michael Lenz, the CFO of Federal Express. The increased dividend we announced today is the culmination of our board's thoughtful efforts over many months. Hogwash, total, absolute hogwash. D.E. Shaw went after FedEx. They announced today a new use of cash with a 7.5% move in the stock, and the dividend explodes higher.
How much is this going to be an increasing strategy for companies that are being buffeted by all the uncertainties and don't see a place to put their money elsewhere? I point to Target and Caterpillar among those companies that have also boosted their dividends, Target being most interesting among them after cutting their forecasts several times in the same number of months. How much are we looking at companies that do not see an optimistic place for their cash, and they're going to return it to shareholders to be disciplined and support the valuations?
Buffeted by the pandemic, no question about that, but the model for FedEx out right now on free cash flow and, importantly, cash from operations, Lisa, this is not Coinbase. This is a money-making machine, as we all know when we send the package out.
And it wants to remind its shareholders of that by saying, here you go, you can have some. And how much is this getting ahead of what's to come in terms of the turmoil to bolster their position? But also, again, where else are they going to put it? If people are not confident in the future, where do investments go? And that's going to be something that you've been asking a lot about, Tom. Where do they put their cash? What do they do with their cash?
What do they do with it? And the catalyst here of D.E. Shaw, I mean, FedEx announces actions to enhance stockholder value and updates to board governance. So an important announcement there, and maybe we'll see much, much more of this in the coming months. I guess, Kaylee, I'm not going to see that announcement from Coinbase.
Yeah, no, it's not looking likely. Brian Armstrong says that reining in costs in this environment is really what the company has to prioritize. As a result, they're cutting their workforce. It was a different environment just a month ago. That is what he said. He has said things have rapidly deteriorated over the last month, and Coinbase isn't the only one that's feeling that.
On FedEx, D.E. Shaw agreed to some customary standstill provisions. So I guess they've come to an agreement. We agree to stay with you here. A most eventful morning. Futures lift. Futures up 27. A better tape.
Keeping you up to date with news from around the world with the first word, I'm Ritika Gupta. President Biden, in an Oval Office meeting last week with key members of his cabinet, indicated he's leaning towards removing some products from the Trump administration's China tariffs list, according to an Axios report. With inflation at a 40-year high, the Biden administration is looking to show action on bringing down those prices. Hot, dry and windy weather is challenging fire crews from California to New Mexico, with wildfires forcing hundreds of people to leave their homes. Roughly 2,500 homes have been evacuated because of two blazes on the outskirts of Flagstaff, Arizona. The high winds have grounded firefighting aircraft. The spending power of UK households fell the most in more than 20 years as wage increases were eaten up by the fastest inflation in decades, according to the Office for National Statistics. The figures show how pay for most workers is failing to benefit from what is the tightest labor market in living memory. South Korea's top diplomat says that North Korea has completed preparations for a nuclear test after talks with Secretary of State Antony Blinken in D.C. South Korean Foreign Minister Park Jin said the North would pay a price if it moves ahead. The test would be North Korea's seventh. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Important part of patriotism is to develop American technology, because I think we will have a techno-economic war over the next 20 years globally, and the U.S. venture community can make a large difference in that.
The gentleman always and forever from Sun Microsystems, Vinod Khosla with David Rubenstein, Bloomberg Wealth. A very, very important conversation with someone who has always over the decades tried to think harder than everyone else about what the future will bring. David Rubenstein joins us now. I do want to mention first, so the tape doing better off the PPI data. We've come off the bottom of the two-day gloom that we've had. David Rubenstein, on Vinod Khosla, what to me is so important is Ian Bremmer's essay last year on the power of technology. You talked to Mr. Khosla about technology and the tension between China and the United States. Who holds the power?
Well, Vinod Khosla, for those who don't know, has been one of the leading venture capital investors in the last several decades, first at Kleiner Perkins and now at his own firm, Khosla Ventures. And he is an Indian immigrant. He came to the United States, got his degree at Carnegie Mellon and then Stanford Business School, started Sun Microsystems, as you said, one of the founders there, and really has made some of the most impressive venture investments over the last several decades. making billions of dollars for his investors. He said that he thought there was a war, perhaps a economic war between China and the United States that could arise over the next 20 years. And he thinks that his native country, India, could be an ally in the United States in that war. There's no doubt that there's technology tension now between China and the United States. And he thinks the venture capital community can play a big role in trying to moderate that tension to some extent and maybe bringing those countries together by cooperating to some extent, if possible, on technology investments.
And David, as you as a leader on this, and I want to bring in Dr. Bremer's thoughts from his essay last year, there has to be a responsibility on the part of the young Turks of technology in America to think internationally and think interdependently. Are you optimistic they're able to do that?
Well, I think they're more likely to be able to do it than our political leaders are going to be able to do it, because I think the political leaders are right now at loggerheads about how to cooperate. But certainly the business people are willing to cooperate and can, if there are not government challenges. Sometimes the government puts blocks in between between cooperation between venture investors from China or India or United States. So I think the technology community recognizes it has the future of the global economy in its hands to some extent, because so much of what we're now doing, the way we live, is dependent on technology investments. 20 years ago, people wouldn't have said they could, they didn't know about Google, they didn't know about Apple, they didn't know about Facebook, and now we can't live without some of these companies, or Amazon as well.
Well, we can't live without some of these companies, and yet they have seen their share prices decline rapidly in remarkable fashion this year. Valuations really coming in across the tech space. David, what were his thoughts around that, on these valuations becoming a bit more depressed?
Well, it's one thing when you had the bubble burst in 2000 or 1999 and 2000, because you had companies then had no revenues and had essentially no earnings at all. Now you've got gigantic companies, Apple, Amazon, Google, Facebook, Netflix, that have large amounts of revenues and earnings. So yes, maybe the valuation is a little bit high today. I wouldn't think that these companies are going away the way that some of the companies went away in 1999 and 2000. These companies are now embedded in the fabric of our society, and I just think their valuations may fluctuate, but it's not like they're going away.
Okay, well then let's talk about some other more nascent companies that maybe are seeking venture money. The exit may be getting a little bit more difficult. It would be a rough market to go public in. It is a rough market to raise capital in. I mean, how is venture changing in an environment where money is no longer free?
There's no doubt that valuations have come down in the private market as well as the public market, but these things happen from time to time. The question is whether it's a good company or not. Take SpaceX, for example. It just raised money at a very large valuation. I think a valuation of over $1 trillion, and not over $1 trillion, but they raised $1.7 billion, I believe it was, at a very high valuation. I think the valuation was $125 billion. I think eventually they think they might get it to $1 trillion, but there's a valuation where $125 billion more or less valuation for SpaceX is still a large amount of money to raise in the private sector at a large valuation. So the technology valuations have come down for sure, but they're not exactly disappearing and going to zero.
David, very quickly here, we've got to get back to these crazy markets. You said a number of months ago, maybe weeks ago, that the genie's out of the bottle on crypto. We are seeing painful losses in Bitcoin right now, with announcements from people that immensely respect Carlyle and what you've done for years. Give us an update on Bitcoin and the rest. Is it believable?
Well, I'm not the leading expert on the subject, but my view would be that when I said the genie's out of the bottle, I don't think these things are disappearing. Their values will fluctuate for sure. But suppose you bought Bitcoin at 50 cents or $1, as many people did, and now it's at, what, 20-some thousand dollars still very high. So sure, if you bought it at $60,000, you've lost a lot of money. And I'm not saying these are great investments, but I think these are investments that aren't going to go away. And I don't think the whole crypto economy is going to collapse, nor do I think blockchain is going to disappear. Blockchain is an important part of a lot of these cryptocurrencies. So we're obviously in a market decline, and in a market decline, everything goes down. So it's not surprising that something that is as ephemeral as crypto would go down. But I don't think people are going to basically abandon the whole concept of cryptocurrencies just because the market's down for the last couple of weeks.
David, thank you so much. David Rubenstein with Vinod Khosla, and look for that, of course, tonight, 9 p.m., Bloomberg Wealth as well. Kaylee, I just did that so you got a nice soundbite for crypto at 1 p.m. with Mr. Rubenstein saying don't throw the baby out with the bathwater.
Yeah, I appreciate that. We can replay that sound at 1 p.m. Eastern Time. Really excited for that conversation. But as David said, Tom, we can talk about what's happening idiosyncratically within the crypto space, but really it's just emblematic of what we're seeing more broadly in a macroeconomic environment that is getting more and more difficult for companies across the board. And that's what you're seeing playing out in risk sentiment, not just in cryptocurrencies, but really any risk asset out there, even if we do have a semi-rebound rally taking place this morning. Within the lines ecosystem, which we all know about. Let me do a data check here to save the show. Futures pretty much stable. The VIX pretty much stable. Today, 33.34. Futures off PPI, which was more quiescent than the gloom, have lifted up 6 to up 19. I'm going to call it a little bit of a lift. That's all I'm going to give you. Dow futures up 100 as well. NASDAQ moving up 0.8%. The yields, they come in a little bit, but I don't want to write home about it. 3.29% on the 2-year yield. To me, the real news, and of course, this was the announcement by the White House that the President of the United States will attend the royal family in Riyadh, and the oil price is back up to a 124 level, up $1.53 on Brent crude, 123.80. Dollar resiliency today, and of course, sterling having a tough go of it. 120.64. Maybe the president will visit with the Queen on the way home. Please stay with us. An eventful day coming up. Ambassador Haas in the 12 o'clock hour. This is Bloomberg.